A very cheerful morning to respected speakers, dignitaries, members, and my dear participants. Today, I, Akshit Maheshwari, we have gathered here today for a webinar on the topic Forensic Accounting and Analysis of Financial Statements, which is organized by Digital Accounting and Assurance Board of ICAI. My dear participants, as you all know, the number of fraudulent activities and ambiguous financial frauds have been accelerating all over the world. We all must have come across in our professional life at least one case of financial fraud happening around us. So, this somehow has led to the forensic accounting and forensic accounting industry turned into a major growing industry for chartered accountants. Forensic auditing has established itself as a dynamic and strategic tool in not only combating corruption, but also financial crimes and frauds through investigations and resolving allegations of fraud and embezzlement. For today's webinar, we have got such tremendous, excellent speakers with us who are going to enlighten us on forensic accounting and how to analyze the financial statements. So we have amongst us our first speaker of the session, CA Bharat Jeswani. Now, before I request him to speak up on the topic, I'd like to introduce him first for all my participants. He is a chartered accountant and he is having 15 years experience in forensic accounting, fraud investigations, due diligence, internal audits, and fraud risk management. He is also the author of the book titled The Frauditor. He has trained CBI officials and working currently with ED officers. He has been also a consultant to Directorate of Revenue Intelligence. I request CA Bharat Jeswani sir to kindly take the stage.
Thank you. Thank you so much, Akshit, for the. Did you say something? Sorry. Am I audible?
Yes, sir. Yes, sir. Yes, sir.
Okay. Thank you so much, Akshit, for the warm welcome and the introduction. So I will just first share the screen and then I'll take it from there. Is my screen visible, sir?
Yes, sir. Yes, sir.
Okay. Thank you. So I was not supposed to be the first speaker. Jindal sir was supposed to speak before me. So we had discussed and he was supposed to discuss about the concepts of financial analysis of financial statements in and the relevance in fraud detection and forensic accounting. And so based on what he was supposed to discuss, I was supposed to talk about the real life cases. So anyways, he will be discussing that after me. So I will be discussing the cases now. We all, I'm sure, as chartered accountants, we all do have much more than the basic knowledge of all these type of fraud detection techniques using financial statement analysis. Sometimes not even consciously, sometimes even unconsciously, we are aware of so many things while auditing, while doing internal audits or while doing due diligence. We come across financial statements and we come across anomalies and we are able to spot them naturally. That is something that comes very naturally to chartered accountants, because chartered accountants are naturally auditors, and that is one skill that comes up naturally to us. So I'm sure, directly jumping to the cases also, you would be understanding everything that I would be saying. So I hope this session is fruitful. I've taken up about 15 cases that I'll be discussing. Small cases, just the core aspect of the case that I'll be talking about. How analysis of financial statements could help us detect fraud in those cases. That is all I'll be discussing. So it is not the complete case, it is just an extract from the case. Most of these cases are my own, which I have actually investigated, or in which I have detected fraud. Some cases have been created for the purpose of explaining the concept. Just 2-3 cases are created. Rest are real cases only. So I'll just start with the first case. So this is a case of a consumer electronics company. So a company that sells electronic items. Okay. So this is one thing which is very common, which you have seen in big entities. They have huge, very aggressive revenue targets, which are being set up by the board. And because of these huge revenue targets and aggressive revenue targets, there is very high probability that to meet those targets, they would be manipulating the books of accounts. So this is very common. This has been seen in many cases. So in this case, we'll be talking about how this company, the name is fictitious, of course, Electrotech, which modified its revenues, that manipulated its revenues just to meet the targets. Sometimes not just the bonuses, but also the remuneration or the survival in a company is dependent on the meeting of targets, is hanging on the meeting of targets. So that is the reason why people would, when they do not have any resort, they would want to manipulate the accounts, manipulate the financials, just to survive in that organization. So this is one red flag. See, when you are auditing an organization and you realize that they have overly aggressive revenue targets or overly aggressive targets in any domain, so there is a very high possibility that because those targets are very difficult to meet, the employees would be manipulating the books of accounts. So this whole idea of having this red flags, which the red flag here is that they have very aggressive revenue targets. So when you have a red flag, when you can clearly see a red flag, you should always look for what that red flag is pointing at. So in this case, what happened was Electrotech reported a 25% increase in revenue, which is significantly deviating from the industry average of 5 to 7%. So if no entity in the similar industry, for example, now here we're talking about the consumer electronics company. So in consumer electronics, all entities are have seen an increase in revenue about 5 to 7%. So it is single digit, mostly less than 10%. So if it is expected that that would be for all the entities. Now, if some entity is showing a revenue increase of 25%, so that is one, has to be something fishy about it. And if there is nothing fishy about it, then there has to be some reason, there has to be some explanation as to why this entity is making so much money. How are they able to sell so much when other entities, do they have some kind of a price advantage? Are their products, do they have a very strong and powerful brand for the reason other brands are not that good? So here, when we are talking about a 25% increase in this specific company and 5 to 7% increase in other companies, we are very specifically saying that, these are similar entities. Like when we are talking about Sony and then we are talking about LG, Samsung, these are all entities that are close to each other. And then now LG and Samsung are showing 5 to 7%, but Sony is showing 25%. So that would be something that one has to look into. Now, along with that, just with the sales has increased to 25%, and the industry showing 5 to 7%, the receivables have also grown by 40%, which is much higher than others in the same industry. Or when you look at this entity itself from the past, so it has a much higher growth in receivables also. So these two things that we observed, and all these things, you observe very obviously when you are just analyzing when you're just holding a balance sheet or you're holding financials, you can see all these things. These things appear to very directly. They don't. You don't need any specific tools. These things are very natural to spot. Such major increase in the revenue and the receivables. So we did a trend analysis, compared quarter to quarter revenue growth and receivable change. So we checked how overall in every quarter how much is the revenue been growing, so and how the receivables are being growing. So when you check that quarter to quarter, no, you will realize that okay, the revenue has been increasing uh, every quarter by say 4%, 6%, and in this quarter suddenly there has been a 25% increase in the revenue. Same for the receivables. The receivables have been increasing at say 10%. Rather, no, it would be in the same as sales would be increased somewhere around 5 to 10%. And then suddenly in this quarter, we see a rise in the receivable of 40%. So what has been happening? Now, when you see these two trends here, the two trends, one, that the sales have significantly grown in that specific quarter, and at the same time the receivables have also significantly grown in that specific quarter itself. So you realize that these sales are probably not real. They are fictitious. They are not the quality of earnings is very poor, so they are just booking sales, and the receivables are fake. They are not, because they are just for time being to meet the targets, they have booked the sales and they have shown receivables. Because if the sales were real, they would probably be converted to cash. Not all sales would not be receivables. Most of it could be also be converting into cash. That even if they are being converted to receivables, this appears to be not real. They appear to be fake. So then we analyzed receivable turnover, and just a second. Yeah. So analyzed receivable turnover and days of sales outstanding ratios. So you will be, I think, sir would be discussing Rahul sir will be discussing all these ratios in great detail. Receivable turnover is receivable upon sales. So the receivables have been increasing significantly, and the sales have also been increasing, but the receivables have been increasing much more than the sales. So in this case, the receivable turnover ratio is significantly lower, and days sales outstanding, again, that is completely dependent on the overall receivables that are outstanding. That is also appears to be significantly higher. So the receivables are significantly higher than they are expected to be, and receivable turnover is very low. So the receivables are not turning; they are not being converted into cash. So both these things point at fictitious sales. So now we also did segment analysis. That is, we evaluated revenue streams by product line to identify irregularities. That was again done. The reason being that different products have different targets. It is not a blanket target which is being set. So when we are in the consumer electronics company, we have different type of products. We have televisions, we have PlayStations, we have other type of headphones. So there are different targets for different type of products. And what we observed here was the product which was in which the manipulation was maximum was the one where the targets were really aggressive. Okay. So we discovered that the sales teams were incentivized to close deals by the end of the quarter, leading to aggressive sale tactics. So here in this case, it was not about their survival, but the bonus was basically dependent on the sales target. So if you meet the target and if you cross the target, so you would be paid more. So that was the case, and that is why it was being done. Okay. Fake sales, uncovered sales recorded for deals that were not finalized or for products that were not yet shipped. So they would just book the sales. Okay, there were the product as per our accounting standards where for revenue recognition. So there are some conditions. So when you want to book a sale, there has to be, proper contract. The payment terms should be clearly identified. The payment receiving capacity, that has to be understood, and the goods should be dispatched or the services should be rendered. When all these things, all the conditions are met, only then should we recognize the revenue. But here what they were doing is that there was a product and they were not even being shipped. For some cases, the vendors were also not real, and they were just booking the sales in their books. So this was one case of overstated revenue. Now, it also, revenue recognition violations, as I just discussed, revealed improper revenue recognition practices, including recording revenues advance for product before product delivery. Okay. So this was one case in which we just observed the when we just looked at the sudden increase in sales. So when you are doing an audit, when you're doing an audit and when you are comparing just the last quarter. So this came up in limited review when we were just looking at the last quarter figures, and then we were looking at the current quarter figures. So when we are doing a limited review, actually it is not the auditor's responsibility is not very high. It is the management that makes the accounts, and we just need to give our opinion, and simply the responsibility is much lower than what is in case of an audit. So we also, when we are doing the review first, basically we just have a bird's eye view at the financials. So this was so obvious when you're looking at the financials. Was some such striking difference in the revenues of previous quarter and the revenues of this quarter, and then again the receivables which are just accumulating. So that when you look at it just by a glance, you can figure it out. So after that, we did all these trend analysis, ratio analysis, segment analysis to dig deeper. So all these are methods of analysis of financial statements, which the first step is basically looking for anomalies. So whenever you are auditing or whenever you are analyzing some financial statements, look for anomalies. Okay, when you come across an anomaly, then you can use these techniques to uncover frauds. Okay. So we'll just go to the next case. I'll have a look at the time because I need to be sure that I complete most of the cases before my time ends here. Okay. So this is another case of underreported expenses. Now, CodeMax Solutions, again, fake name, an emerging software company, was under pressure to show profitability. This is most of the time, in most of the cases, because those days are gone when people used to, reduce their profitabilities to evade taxes. That is a very rare phenomena which I see these days. Most of the time, organizations are just trying to increase their profitability, and whatever they do is just to increase their profitability, because they are mostly looking for funds, or they are looking for some IPO. So some or the other way, they are always increasing the funds. So the financial indicators, inconsistent expense trends. Despite significant expansion in operations, CodeMax reported only a marginal increase in operating expenses. So this is a very obvious thing. Now, if I have one office, okay, so I have about 50 people employed in that office. Now I'm opening up another office. So I'm doubling my operations. So obviously my expenses of operating expenses have to, if not double, at least they have to increase significantly. That is one thing that has to be understood. So when we saw their balance sheet, we saw that they have now started with another office, another area of operation, but there is the increase in operating expenses is not significant. It's just would say 10-15%. The operating expenses had increased from what they were in the first originally. So after this, it just increased by 10 when it was supposed to be double, somewhere close to double. So unusual profit margins. Profit margins were abnormally high compared to industry standards and historical company data. So they were basically looking for funding. So they wanted to show that their profits were high. And even though they were expanding, those expenses were not being booked, or they were being booked in some other. We'll see how what actually they were doing. So the techniques that we used was again trend analysis. We looked at the historical expense reports so we understood, they were operating here and they were operating. So these were the expenses. So these were the expenses for salary, then the rent that they were paying, and other administrative expenses for electricity and everything else. So whatever. Now then we see that they have started another operation, which is of the same level, but the expenses have only increased by 15%. So we specifically looked at the expenses of that new operation because, and then we see that it is just now, if you want to operate an office in a very prime area in Mumbai, and for that you have opened up a office in South Bombay. So you cannot expect that, in Bandra you are operating at about, you are paying like 2 lakhs including rent and other fixed costs, and here you are just paying 25,000. It would be much more than what you are paying there. So here we saw that it was much lower. Then we did some ratio analysis, compared expense ratios to industry averages and historical company performance. So these are two things that we are doing here. One, we are comparing the ratios, expense ratios. So if we are having an operation of say 50 employees and we are making a revenue of say 1,000 crores. So in that case, we compare our expenses and we compare it with the turnover, our own turnover, and we look at our historical data as to how much turnover were we making, and for that what were our expenses. Also, we compare our expenses to the industry average. So in the same industry, what other entities are making. So this is a bit tricky. It is easy to discuss here. You don't easily get the industry averages. See, if you are comparing your entity with a listed entity, you can get their financials very easily. They are mostly publicly available. Even for private limited companies, you could download the financials and then you can, get the broad figures. However, if you want to dig deeper, you will need some. It is not always possible, especially if you are a partnership firm or a proprietorship firm and you are operating at a small scale. It is not always possible. But here, in our case, what we are talking about is a very big entity, private limited entity, but it's a big entity. So in that case, it is easily available. That information is easily available. Okay. So what we observed here was there was an expense misclassification, discovered that significant operating expenses were incorrectly classified as capital expenditure. Again, this is classic easy way of manipulating the books of accounts. Classify expenses instead of operating, you classify them as capital expenditure so that you don't immediately reduce your profits. Rather, you would be charging depreciation over them, and it would be distributed over number of years. So this is what they were doing. So they did not want to reduce their profitability immediately. Now they were booking the complete revenue from the new office, okay, the new business that they started. They were booking all the revenue from there, but when it comes to expenditure, they were now shifting those expenditure from operating to capital. So now there was delayed expense recognition. Company was also postponing the recognition of certain expenses to future periods. So, for example, if I, you know, got an internet connection, and if I am now using it, now the internet connection I have paid for the whole year. Okay, for the server data, for the servers, for the internet, and for many things. It is a huge amount that I've paid for the whole year. And then now it has to be divided every month, okay, equally. But what I'm doing is that I'm just not booking anything right now. And in the next financial year, mostly I'll book the expense. So currently, I'm using the internet, I'm using the services, but I have not booked anything in my books. So this is these are small techniques, but as you see that, you know, this was easily observed because uh, they have increased their operations, but with the increase in operations, there is no direct correlation with the expenses. So the first step is always just looking at the financial statements. Okay, you just look for anomalies. That's all. Anything that looks fishy, anything that does not make sense, that is what you're looking for. So after that, to dig deeper, you do these analysis, you know, these tricks, these steps, trend analysis, ratio analysis, all these things are done to further dig into the fraud that you have discovered. Okay, so we have covered the second case also. So I'm just discussing on a very primary level, where we are just talking about the case, the main aspect of the case that we have to discuss, and then how we first figured out that there was something missing, or there was some manipulation, and then what kind of analysis tools that we used, that we are discussing. Okay, inventory manipulation fraud. Okay, Trend Fashions, a retail chain specializing in fast fashion, faced market pressure to show strong financial health amid declining sales. Again, so there must be some reason why they would be doing that. Probably they would be looking for funding or some new investor. So that is the reason why they were. So they had they manipulated their inventory. Okay. So inconsistent inventory levels, despite reported declining sales, inventory levels on the balance sheet increased significantly. Okay, this is, I think, the oldest trick when it comes to financial manipulation, which I think every chartered accountant would be aware of, which is manipulating the closing stock. So this is what they were doing. So there is, the sales are declining. Okay, but the profitability is not. So what do you manipulate? You manipulate the cost of goods sold, and you manipulate the closing stock. So even though you are selling 100 units, that would cost about, say, 1 lakh, but you are just showing that the goods that have been sold have been for 40,000 only, and rest is closing stock. So when you look at the financials, you're not giving the number of units in the financials. Of course, in the notes and everything, there would be other details, but in the financials, you're not looking at the numbers specifically, the units specifically, just the numbers. So this was what they were doing. So the cost of goods sold remained unusually low compared to the industry average and historical companies. Again, here also what we have done is we have verified the COGS. We have verified it, compared it with the industry average, and we have also compared it with our historical data. So we know that we have our gross margins at, say, 20%. So 80% would be the cost of goods sold, and of the sales value, 80% would be the cost of goods. But now we are looking at the COGS, and it is somewhere around 35%. So it is obviously much lower then. And now we also compare it with the industry average, because we are not sure that maybe for some reason the profit margins have increased in this industry. Obviously, it won't be such a huge jump, but still there is a possibility that maybe we have to give a benefit of the doubt. So we would want to check if the according in the industry is how is it going. So for that, we'll be verifying the COGS to sales for industry average also. So what we found was we did the inventory turnover ratio analysis, compared the company's inventory turnover ratio with industry benchmarks. Again, the sales to inventory, and we compared it with the industrial average also. We also did the gross margin analysis again, which is what, as I said, that earlier the gross margin was 20%, now the gross margin was 65%. So we compared it from our own historical data, and we also compared it with the data that was from industry, that is from other entities, averaging out for the industry and then comparing it. So we did that also. So what we saw was that, again, closing stock was overstated. It was artificially inflated by reducing the COGS and keeping the closing stock higher, and deliberate understatement of COGS. Both these things go hand in hand, because one, if you have to reduce the COGS and you can inflate the closing stock, so obviously the gross profit would increase. So this also came to our notice when you're looking at suddenly the gross margin has increased. So that is very near impossible. So this also reminds me of an interesting case where I was dealing with a FMCG company, wherein they had approached me to investigate a fraud of somewhere around 50 lakhs, 50, 70 lakhs. There was some difference in the stock price, which stock valuation, which they had come to me for, wherein they were saying that, we've as per our books, there's 70 lakhs of stock lower in this. So just when we started the investigation, that was okay. We just started from the what we did was we got all the historical data. We started from when the stock from the beginning, because we did not have the data from the beginning, so we just took it for last 5 years. So we made up a complete stock movement analysis. So we started. So okay, this was the opening stock at that time. Whatever opening stock they are reporting, let's just take that. Let's not assume that it is being manipulated. Let's just take whatever they have reported. Let's take that as opening stock. Then we are sending some goods across. So let's add it to the stock that we have sent to them, and then they will report the sales figures. So that much stock would be reduced. So this should be the stock that should remain. So that will be taken as opening stock for next year. And this should be the profit, that gross margin that we should receive. After the gross margin, we'll check up all type of expenses they are booking, if there is overstatement of any type of expense, anything that they would have done. So we'll be looking at that. So that would come later. But what we observed was that organization should have a gross profit margin of, say, 20%. And what they were showing in the balance sheet every year was 5%, somewhere around 5%. So this was our first observation. Then we just spoke to the management about it, because see, we are aware that management would probably manipulate the books of accounts to save taxes. So there was a possibility that the books were manipulated, but then the management was not aware of any kind of manipulation. So they told us that, no, this is the margin. So the first question is that, don't they see it? It is, you are aware that on an average, whatever goods you are selling, there is a wide variety of goods that they were selling. So there were about 100 different products which they were selling, which they were manufacturing and selling. So now when you're looking at that, you're saying that, okay, on an average, if we take an average of all our goods, it comes to somewhere around 20%. Let's go to a lower scale, say 18-15%. because some goods are sold for 25-30%, some are sold for 12-15%. But lowest, even the lowest, if all the goods were sold at 12%, still we would have a gross margin of 12%. And what I'm observing is that they are just booking a gross margin of 5% every year. So that was, again, they came with a 50-60 lakhs fraud, then which got converted into a 5-6 crores manipulation of profits. Okay, that is another story. So, okay. So we'll go to the next case, which is fictitious transactions fraud. So there is this Invotech, provider of IT services, faced intense competition and pressure to maintain its market position and investor confidence. So there were unexplained increase in revenue. Infotech showed a sudden unexplained increase in revenues despite a stagnant market. So this is one thing that you can also observe, especially when you are auditing. When you're auditing a company or an entity, so you are quite well aware of what the market conditions are. You are reading business newspapers on a daily basis. You are aware which industry is doing, which industry is facing some kind of a problem. How is it going? You can very well judge. So this is an IT service providing company, was so there was a shortage of demand for IT services at that time. But despite that, their revenues were not stagnant. So they were not maintaining the same. Most of the companies in this industries at that time were uh, declining. They were showing trends of declining revenues. So they were, and few of them were showing stagnant revenues. Every quarter to quarter, there was no increase in revenue per se. So they were maintaining the similar because they had some contracts, fixed contracts for which they were being paid, retainer contracts for which they were continuing, but they were not getting any new clients. So at that time, this company was showing unexplained and very high increase in the revenues. Okay. But so when you see the first unexplained increase in revenue, the first thing that comes to your mind is maybe the quality of earnings is not right. Me, being somebody who is surrounded by, I mean, who is into fraud investigations, surrounded by fraud most of the times. So it is I have a natural suspicious mind. So the first thing that if it comes to me that there is an unexplained increase in revenue, so one should be happy. The revenues are increasing. The first thing that comes to my mind is that it is something fraudulent is going on. So probably fictitious revenue is the first thing that would come to my mind. And so I would look at the cash flow statement. So okay, how much of these revenues are being converted into cash, or are they just making a fake receivables? I think something. Okay. Okay. So cash flow we would analyze just to understand how is the revenue, uh, the quality of earnings, how it is moving. Now, cash flow analysis, we compared the reported revenues to cash flows to identify if there was any discrepancies. Sales and account receivables reconciliation examined alignment between increased sales and account receivables. Because there were such discrepancies, so we called for an external audit so that we could understand why these discrepancies were happening. Okay. So there were fake sales entries. Audit revealed that numerous sales entries with no corresponding delivery of services or cash flow. So it is very easy to book, a fake sales when you are in a service industry. When there are goods, no, there is still something that you need to understand. So the goods are material. If you are manipulating the stock, if you are just showing that we have booked sales, but the stock has not moved, like we had discussed in one of, I think, the first case of electronics, where they were booking sales, but there were no shipments only. There was just the stock was lying in their go downs. So there, in that case, it is still easier to detect. In the service industry, especially there are so many fund movement which is happening with consultancy services. So somebody is saying that, okay, we paid them for consultancy services. What service was rendered, how it was rendered, all that is because they are not, they are credence goods. When you're talking about services, they are not real goods. They are uh, air. So in such cases, it is much easier to manipulate the books. So what they were doing is they were uh, showing sales entries that we have, provided services to XYZ entity, and we will be receiving the funds. Uh, and there was no corresponding cash flow for a very long time in that case. Okay. They also created so many clients which were non-existent, showing, fabricated, completely fabricated transactions. So they were, because if they would book those uh, transactions with already clients, so what we every quarter, naturally, or every at the end of the year, we would be sending them the ledgers to confirm the ledgers. So this, they would be caught. So they created fake clients, and they uh, were sending them, were booking revenue for those fake clients. So this, excuse me. So this was when we the first instance came in, when we saw that the revenues are increasing in a stagnant market, where most of the entities have declining revenues. This entity is showing very high revenues, and then there were also cash flows which did not align. So if the revenues were being booked, it is very easy to manipulate the revenues when you are in a service industry. You can book any kind of revenue that you are providing consulting services, and we have provided the services this year, we'll be receiving the revenue in the next financial year. And it is very easy to do that, and that is what they were doing, basically, just to keep up, maintain their market position and investor confidence. They were just manipulating. So what we did was, uh, first we compared their revenues, uh, and we compared it with the industry average and their uh, historical revenue. Then we compared, when we did a cash flow analysis, we saw how many revenue, how much of the revenues was being converted into cash. So that we did. And sales and account receivable, exactly how, with sales, all the sales were getting converted to account receivables. That was one reconciliation. Then we did account receivable to cash reconciliation. That was also, there was no account receivable which was getting converted to cash. Then we also looked at the customers which were new. So most of these customers which were converted to receivables were new, which were not old customers, which and then we analyzed if they were real, by looking at what location they were from, and doing a public search on those entities. Then we realized that they were all created entities, just vendors created in the system to book these revenues. Think just excuse me for a minute. I'll just join back.
Till then, if any participants have any question, they can drop that in the question box and we can take it up after the session of the speaker is over.
Yeah. Okay. So let's move to the next case. Okay. This is a case of improper asset valuation. Okay. So facing a downturn in the real estate, this is again a real case, but this is not from India. This was, I think, this is from Dubai. So a company which was facing uh, downturn in the real estate market, Prime Land Realty, which is again a fake name, was under pressure to show strong asset values to secure loans and attract investors. So what they were doing is they were manipulating their uh, asset value. Again, this is another area like the closing stock. The valuation is another thing which has a lot of subjectivity. So most of the regulatory or tax authorities are trying to standardize the process. So they are always limiting the valuation methods to a few, and that also they have many rules in that. So there is a lot of standardization happening, but still valuation is the place where a lot of manipulation can be done. So what they were doing, a significant increase, there was significant increase in the reported value of real estate buildings without corresponding market growth. So they revalued their portfolio, they revalued their assets, and they revalued it a significantly higher amount. So they made it, so if they had assets of about 300 crores, they made it about 500 crores, simply because they wanted to secure some loans based on the value of those assets, those properties. But there was no change in the market condition. There was no upgrade to the asset that they were holding. Not that they kind of changed anything about the asset. It was the same asset which they were holding. And so if you have an asset which is valued at, say, 10,000 dirham per some area at, and now suddenly you are saying that it is not 10,000, it's 20,000. So that does not make any sense. Why suddenly in 1 year the value has inflated so much beyond understanding. So there was a significant increase in the reported value of real estate without corresponding market growth, abnormal depreciation rates, unusually low depreciation expenses for properties compared to industry norm. This is not possible in India because you have specific in depreciation rates which you have to stick to. You cannot just on your own decide what is the value of depreciation that you will be booking. So again, there was unusually low depreciation expense. Then there was an asset. So we analyzed the asset turnover ratio, evaluated the efficiency in using assets to generate revenues. Now, how the valuation was done? Okay, so the valuation is being done based on discounted cash flow basis. Okay, so now I'm saying that this asset will generate XYZ amount of revenue in next 20 years. So then based on that, I will be discounting that revenue to bring it to the today's value. So I think I'm sure we all are aware of what discounting is. So then we calculate what today's value is. So this is how it was being done. So then we realize that the valuation is definitely inflated. There is a very high inflation in the value. So we just analyzed how the valuation was done, what kind of figures were used to calculate the current value using the discounted cash flow, what rate of return was used to discount, uh, and what were the expected cash flows from that. So that was one thing that we analyzed basically. And then we also compared the market data as to what is the expected revenue. So what other entities are booking, how other entities are doing their valuation. So that is what we again analyzed, compared it with what they were showing. So this is what we did. Uh, Obviously, we discovered that there was a deliberate overvaluation of the properties based on unrealistic future development prospects. So now, normally, we are getting, as I said, we are getting a rent of 15,000 dirhams from a property. And now we are assuming that we'll be getting 15 lakh dirhams after 2 years, and then maybe 1 crore dirham after that. So that is just uh, wishful thinking. That is not real. And that was obviously being done to increase the value of the properties. This happens because in this, and this goes unnoticed also many a times, because banks themselves are colluding with the borrowers so many times. The lender, I mean, when I'm talking about the lender, I'm talking about the bank manager. The bank would not do that, because then they would uh, suffer a loss later. So but the bank manager, who is the lender, they would obviously get some kind of healthy commission out of it, good commission out of it. So they are colluding. So they ignore such valuations. I've seen cases wherein uh, the valuations and the future projections are just simply unbelievable. I mean, nobody can uh, understand. So I also just reminds me of another very not just interesting, a very funny case, wherein I was just sitting with a banker, and somebody had come up with a requirement for funding, working capital funding. That person was in the business of selling eggs. Okay. And he wanted a working capital loan. So he had many chicken and hen, that but uh, and he used to sell eggs, and he had some complete industry for that. And he was in that business for I think 15-20 years or something like that. So what he was mortgaging, because he had nothing to mortgage for, I think he was looking for a 3 crore loan, working capital loan. And he said that, these eggs will be the mortgage, something that can be mortgaged. So I had seen that shock on the face of the banker at that very moment, as to, how are we going to keep track of, and if these eggs get destroyed, and how are we actually, going to monitor all these eggs. So yeah, always real funny things happen. So okay, so this was again the obvious thing was that what we saw was that the assets valuation were very high. It appeared naturally, and it also appeared as a comparison. When you look at uh, the asset value from the just from the previous year, sudden rise in asset value, there are no market conditions. So then you look at what analysis we did was of the valuation, because what had changed was the valuation. So the valuation was analyzed in detail. What kind of return rate has been considered, what kind of projections have been considered for the revenues that would be coming from this asset, and we compared it to the rates, the figures that similar entities in the same industry were using. So these were the two things that we analyzed in this case. Uh, and we also analyzed the depreciation rates, that there was again sudden fall in the depreciation rates, which they were for years they were charging 15%, then suddenly from this year onwards they were charging 5%. And okay, that can be a reason for some assets, that maybe after some years they would not depreciate that much. But this was unexplained. So when there is an unexplained anomaly, then you have to look into it further. Okay. Okay. I think I will wrap it up in next 15 minutes. Okay. Just a second. Okay. Okay, so we are at an executive compensation fraud. Okay, this one was interesting. So to maintain a favorable public image and shareholder confidence, Global Tel aimed to report modest executive compensation amidst challenging market conditions. So in this case, what was happening was that the company was not doing very well. Okay, and they were paying heavy compensation to their top executives. Okay, so now that did not settle well with the investors, with the shareholders, because obviously they would look at the profit and loss. They would see that we are not making much revenue, but every year we are paying so much of compensation to these few executives who are the directors of the company. So there was inconsistent compensation report. Executive compensation reported in the financial statement was unusually low. So what they did, that they reduced the compensation, because now the investors would start questioning, why are we paying so much to these executives and they are not helping us make any money? Nothing is changing. So we saw that suddenly the executive compensation reduced. It appears very clearly in the profit and loss account. So major difference in the executive compensation. Okay. At the same time, what we noticed was that there was a notable rise in the miscellaneous or administrative expenses without any clear justification. So one head in the profit and loss account, one expense head, that has reduced, and another one has increased by the same amount, a very similar amount. So again, both of them without any justification. So again, this one, you could just look at the uh, financial statements and you can understand what is going on here. But again, then we would do some analysis to make our assumptions more stronger, to make it more concrete. Okay. So we did the compensation analysis, benchmarked reported executive compensation against industry averages. So what our executives were making, what the industry, because we had already observed that it was much lower than previous years. So we compared it with the industry. Okay. Then we also looked at the expense of various expense categories to identify any abnormal. So we just specifically looked at which expenses had increased drastically. So we knew that the compensation had reduced, and by the same amount, the expenses have increased. So which are the expenses which have increased drastically? So we will compare it from the previous periods as to is there any reason why this expense should increase in this current period. We'll also compare it with the industry, because is there some reason why this should be some change in trends in the industry, why these expenses have become higher. Okay. This was actually started by after not by just looking at the statement, basically, and when a whistleblower had informed us that there is something. So anyways, so what they had done was, as you must have guessed also, they found that substantial part of the executive compensation were being reported as consultancy fees and other indirect expenses, which we found when we analyzed the expense report also, that specifically now there was consultancy fees. So last year it was much lower, which was actual consultancy fees, which was paid to some chartered accountants and lawyers. But this time it was very high, which was actually going to the accounts of the executives. So we then also did, it is not written here, but we also did the fund flow analysis, also cash flow analysis, as to where the funds were going, these consultancy fees, who were the vendors. So then we observed that it was going to the same executives. Also, another trick that they were using was they were booking some personal expenses which were billed as operational costs. So that also, when we analyze the expenses, we realize that these expenses have grown drastically, and not just the consultancy fees, but there are some other administrative expenses which have been increasing, and which you cannot correlate with the operations. There is no change in operations. The business is rather declining. So in declining businesses, there is sometimes, more spending which is being done in the marketing side or maybe for business development. But we would see some other operating expenses which did not make any sense. So again, then we realized that where this money was going. So it was again going in the accounts of the relatives of the people involved. Okay. Okay. Loan covenant violation fraud. I think I'll just quickly now go through all these cases because I think I will not have that much time also. So, okay, in an effort to avoid loan covenant breaches during a period of financial difficulty, Durametals in company resorted to manipulating its financial statements. Okay. Despite market challenges, key financial ratios remained unusually stable, aligning precisely with the loan covenant requirements. So this is something again too good to be true. Now, when you're auditing, no, I had come across a case which was so funny. I had or somebody had come for audit. I'm looking at that last year's financials, looking at their current year financial, they are exactly the same, precisely the same. They are booking the same revenue, they are booking the same expenses, and they did not take any effort to change anything because they were not sure what we could then have problems with what we would catch. So they came up with the exactly the same books for auditing. So this is a similar case, even though the company is failing, but their ratios, key financial ratios, that they remained absolutely the same. This you might have also observed when people submit stock statements every month. Sometimes it happens that for 3-4 months they have the exact same stock. This has been, I've observed in many entities, and I have many friends in the banking, and they always tell me these funny stories that they send me the exact same stock, but who has the time to actually verify? So we just accept it because we know what is going on. So then we observed irregularities in cash flow. This another very important thing. Whenever you have any kind of doubt, no, because there is a lot of manipulation possible in the books of accounts, and a lot of manipulation possible when you're talking about the financial statements, because we are on the accrual, which is globally accepted norm. So we are on the accrual type of accounting. It is not real. Real is the cash type of account. So always go for the cash flow. You will see what is really happening, because you can easily book off balance sheet liabilities, you can easily book fake revenues, but if they don't convert to cash, or if they don't lead to payment of cash, then they are not real. Okay. So we examined the critical financial ratios that they had to submit to the bank, and we examined those specific financial ratios and checked with the threshold. The bank wants uh, asset to liability liquidity ratio. This has to be the specific liquidity ratio, has to be 2 or 1.5, whatever. So we checked it with what they were reporting. It was exactly the threshold, just above the threshold which they were showing. So there were two things. One, it was just above the threshold, and it was the same for the like the last period. Okay, even though the business was declining. Then we scrutinized the cash flow, actually how they were having the liquidity, how the cash was coming in, to understand. So this was done by, because this was done by a lending bank, because they realized that uh, there was something was it rarely happens. So I think this is not a real case, it's a fictitious one. So this was started by the lending bank. Okay, discovered that certain liabilities were not reported, income was overstated to comply with debt covenants. So found unreported off balance sheet financing used to manipulate liquidity. So they were getting funds from somewhere which they were showing as some kind of revenue, but they were actually loans. So that is what we found. after doing the cash flow analysis, ratio analysis. Okay. Okay, I think I'll take this one. So these are related party transactions to hide financial difficulties and maintain a facade of profitability. Build well constructors engage in deceptive related party transactions. Okay. Same story, industry downturns, but Buildwell was reporting consistently high profit margins. So what they were doing was they were revaluing their assets, and their revenues also appeared to be very high. So they were doing related party. They were purchasing properties from the relatives at a very low price, and then they were selling it off to other relatives or the parties of the same relatives at a very high price. Okay. So we just analyzed every transaction in detail. Okay. Scrutinized every individual transaction for the legitimacy and market conformity as to how did they purchase this property at this price, what was the prevailing market price at that time, and just in 2 months they sold at double the price. Who was the buyer then? Why? How could they sell it at such a high price? So this is what we did. Uh, the transactions were not at arm length, obviously, which could be very easily compared by understanding two things. One, how they are buying at such a low price and selling at such a high price in a very short period of time. So this itself triggers an investigation. Secondly, you can always get the market rates at to what price the deals are happening nearby. So how they are buying at such low and how they are selling at such high, it was very easy to. And they were shifting profits, obviously, by buying at low and selling at high. They were shifting profits from their related parties to themselves. So this was another case. Okay. Let me just see. There's too much of it. Okay. So I'll just take this one off balance sheet financing because I think this would take another half an hour. I just kept too many cases, but I made my point. Illegal activity. Let's do this last one. Okay. So senior executives of Health First Pharma used company funds for illegal activities, including bribery, personal embezzlement, disguised as legitimate business expenses. Now, notable increase in miscellaneous or consultancy expenses without clear business justification. Suddenly, there has been increase in expenses, and again, the expenses that we observed were increased were in the service industry. So you see consultancy expenses increasing, miscellaneous expenses increasing. Now, discrepancies in vendor payments. The payments made to unfamiliar vendors or undefined services. Now, you first of all see, okay, there has been increase in an expense. So then you dig deeper. First you analyze what are the specific expenses that then you see there is some consultancy expense going on. Okay, then you ask the manager what kind of consultancy and why do we need this type of consultancy. All of a sudden look at unfamiliar vendors. When you look at those, then you see that these services that they are getting, they are not required, they are vague, and then these vendors also you have not heard of. So you are paying 50-60 crores to vendors about which you're not even aware. I mean, who are these? So when I'm buying, for example, if I'm buying strategy consulting services, so if I'm paying 50 crores to McKinsey, it is very understandable, because they could charge me that much for the services. But if I'm paying to 50 crores to some company, Ramlal and company about which nobody has ever heard of, that would always obviously create some kind of a doubt. So this is what we observed. Detailed expenses scrutinized unusual inflated expenses categories and traced individual transactions, conducted background checks on vendors and verified the nature of services provided. This started with after a whistleblower had reported that something is being money is being embezzled. So it was revealed that the executives were using company funds for bribes to secure contract and to embezzle money for personal use. So they will book these consultancy fees for the entities that were owned by some politicians, and for no consultancy that was provided, but it would just go to those accounts and then simply transferring the money, which and some were again transferred to some entities which were then they would get some cash out of it, which they would use, or directly to the relatives, to some companies incorporated by the relatives and their friends. So these were three, four combinations that they were using. Uh, all these vendors, the most of them were fake. They did not actually provide any services. It was just to move the money out of the company for paying bribes and to for personal enrichment. So again, what analysis we did was we analyzed because we first observed that there was an unusual expense pattern. So then we analyzed the expenses in detail. Then we also analyzed the vendors in detail and the type of expenses. All these analysis we did, and based on that, we concluded that this was misappropriation of funds. Okay, I think I will finish here because then it was. I do fail with the time because I keep the content ready for if I just finish it quickly. So I think this should be enough. Akshit, I think you can take it from here. Thank you so much, everybody, for
Thank you, sir.
listening so patiently. If there are some questions, I'm very
Yes,
happy to
yes.
answer here. Please.
First of all, thank you so much, sir, for enlightening our participants with your amazing presentation. I have
Thank
just
you.
a couple of questions.
Okay.
The common question that many participants have, that in your presentation you have mentioned about comparing the ratios with the industry average or the percentage with the industry average. So the
Yeah.
question is, how do the auditor get that industry data, that sales are increasing from, let's say, in a quarter 25% and the industry average is 5 to 7%? So how do they get that industry data?
So this is, as I said, first you have to see, what kind of entity that you are auditing or analyzing. So if you are a very small entity, then it is very, very difficult to get the data, the industry data. But if you're talking about some big entity, then for example, if I'm auditing a listed entity doing 500 crores of turnover who is in a specific industry, so I can very easily get the data of most of the private limited companies in the same industry and with the similar revenue, or also listed companies, which is obviously publicly available. Their annual report, their quarterly reports are publicly available. So you can very easily get, what the financials basically you can get for, and that I think that suffices in most of the cases. If you're talking about the detailed data, which is stock movement or internal reports, that is of course not available. So we have to stick to the outside broader perspective only for most of our cases.
All right, sir. The last question is that how do you analyze when the assets have been are showing at an inflated rate? How to
So
check that
we
inflation?
as we discussed in the case, I think Nanda sir is here. Good evening,
Yes.
sir.
Good evening, Balaji. How are you? Good
Good
evening,
All
evening.
good, sir.
Akshit.
Good evening,
Great,
sir. Good evening, sir.
great, great, great.
Sir, very nice to see you.
Same here, same here. The pleasure is entirely mine. I'm sorry, I was in a seminar in Faridabad. I'm traveling only, so I thought I would speak in between the
Thank you.
sessions. Great. Please carry on with the question answers, Akshit.
Okay, thank you,
This
sir.
is last
So
question.
when we are
Welcome.
talking about the asset valuation, no, now I just discussed a case also. When you're talking about the valuation of the asset, no, we looked at how the valuation was done. In this case, we saw how the projections were assumed, what kind of projections were taken into account, what was the rate of return for that specific. So that is how when you analyze the valuation specifically, how it was.
Hello.
Okay.
Uh, so thank you so much, sir, once again for this wonderful presentation. And now before I request CA Charanjot Singh Nanda sir to kindly address the participants, I'd like to briefly read up his profile. He is serving as a Central Council member in the 25th Council of the Institute of Chartered Accountants of India. At present, he is the chairman of Digital Accounting and Assurance Board ICI, Committee on Financial Markets and Investors Protection ICI, and Committee on Information Technology of South Asian Federation of Accountants. He is also presently the Vice Chairman of Board of Internal Audit and Management Accounting ICI. In the past, he has been a member of Quality Review Board set up by the Government of India. Along with it, he has been a convener of the expert group constituted by Ministry of Corporate Affairs, Government of India on investor protection. It's my great honor to introduce CA Charanjot Singh Nanda to each and every one of you present here. Over to you, sir.
Thanks a lot, Rakshitji, for your very kind words. I'm truly enlightened to be amongst you. Ladies and gentlemen, the basic initiative of the board is to ensure that we fall in line with the expectations of the membership at large. Forensic accounting, information system accounting, cyber accounts, they all have now assumed glamorous prepositions. There are so many assignments, and we want our fellow chartered accountants to be an integral part of that. So most important thing which I would like to tell you now is that we have to get ourselves trained. We have to create such a preposition where we are able to effectively add value, not only to our clients or stakeholders, but to the regulators and government. With making the forensic standards, 23 forensic standards, first time in this world. And I would like to acknowledge the contribution made by Mr. Bharat Jaswani. He was a very integral part of the entire group that framed the accounting, they framed the forensic accounting and investigative standards, and who ultimately went ahead and prepared an implementation guide. I would like to tell you there are 23 standards, out of which 20 need complete guidance. So what happened? We framed a group of close to 160 chartered accountants who were given in trenches the standards. They worked on the standards, they create value, and came to the screening committee. Then the screening committee guided them what is expected of them. And at the end, after the work of the screening committee, the entire standards implementation was shifted to the expert committee. After the expert committee, it went for public exposure, and then 3 legal reviews were done, and then the presentation comes on the table. So I want to tell you, I welcome CA Rahul Jindal, again a very, very well-of-a speaker, a person who understands forensic in and out. Both the speakers today were people who actually go on the ground and do forensics, and they will add value in telling you what is expected of you. So with the implementation guide on one hand and with the forensic standards on the other hand, you could make both of them in the right tandem and study. But please, we chartered accountants feel that we know everything. We feel we know forensics, and if forensic was a person, it would have said, कि क्या यूं ही मुझे चंद लम्हों में पढ़ लोगे तुम? क्या यूं ही मुझे तुम क्या यूं ही मुझे चंद लम्हों में पढ़ लोगे तुम? मैंने खुद को लिखने में बरसों लगाए. So you have to get deeply involved, and the results will be fantabulous. I will not stand between you and Rahulji. Mr. Jaswani had a wonderful inning, and we look for an equally exciting inning from Rahul Jindalji. So over to Mr. Akshit Maheshwari from Ludhiana, and Mr. Jaswani belongs to Pune and from Nagpur. So would request Rahul Jindal, who belongs to Delhi, to take the session forward. Over to Akshitji for present proceedings. Akshitji, the dice is all yours now. Thank you.
Thank you so much, sir,
Thank you, sir.
for enlightening the participants and energizing each and everyone listening to you. It's always so motivating and so inspiring. And moving on to the next speaker, before I request CA Rahul Jindal sir to take the stage, I'd like to introduce him. Rahul Jindal sir is a FCA, and apart from FCA, he also holds the degree of LLB, Insolvency Professional. He is a certified fraud examiner, certified forensic auditor. He is also an IBBI registered valuer and certified concurrent auditor. Rahul Jindal sir has handled more than 50,000 crore rupees of cases of forensic audits for public sector banks, private sector banks, BSE and other financial institutions. I request CA Rahul Jindal sir to kindly formally take the stage and present his presentation on the topic and forensic accounting. Over to you, sir.
Thank you, Akshat ji. Thank you very much for introduction. I would like to thank Charanjot Singh Nanda sir and Dayanand Srinivas sir for giving me this opportunity to share my views, whatever the cases I can share with you is regarding the forensic audit. I hope the session with Mr. Bharat Jeswani was a great session. I was to take the first session, but due to some emergency, I requested Bharat ji to take the session. So I'm highly thankful to him that he took out some time and took the first session and agreed for my second session. So I just share my screen. I'll just share what is forensic audit and how the things are to be taken care of. I'll just share my screen with you regarding forensic audit. My screen is visible, Akshat ji?
Yes, sir. Yes, sir.
So basically what forensic audit is, I'll tell you what is forensic audit. So I'll tell you a brief. What is the requirement of forensic audit? So basically after the introduction, since 2016, what RBI did, RBI had issued guidelines to banks. So once it had issued the guidelines to the banks, they were requested to provide the details whether the account is a fraud account or a no fraud account. So for that, what they did, they made a list of firms, CA firms in India, who will be conducting the audit on behalf of the banks and submitting the report and pointing out whether there are any diversion of funds, any siphoning of funds, and all those things were to be pointed out. So that then the terminology came of forensic audit. Earlier to that, the term used was investigation audit or due diligence. These were the terms that were being used by the banks or various financial institutions. But now, after the introduction of those, they are using the term forensic audit, which is also not correct. I'll give you an example. Like today, I was in the NIRC Regional Council. So our president, he was talking about, our president and Nanda sir, they were talking about forensic audit standards, forensic accounting and investigation standards. So we as an auditor, we are not doing an audit here. We are just giving our information or we are pointing out the flaws that are there as per the RBI Master Circular. So we do not require to give the conclusion. We only require to highlight the cases that where diversion is found, where siphoning is found, and it is up to the court to decide whether it is a fraud account or no fraud account. It is the judge who can pass the judgment, not us. So the term that is being used by the banks is forensic audit, which is not correct. The terms that they should be using is forensic accounting or investigation. So that after doing the investigation or after doing the forensic accounting, we can highlight the issues that are there as per the RBI circular, and accordingly the court or the financial institutions can take a further course of action whether to classify the account as a fraud or a no fraud account. But nowadays, I'll say the practical scenario is a bit different because of the fact that whenever you get a forensic audit, the banks will approach you, the banks will ask you to provide a conclusive report, whether fraud or no fraud. In continuation to that, now Indian Banking Association has also issued some guidelines. In 2019, they issued an internal circular to the banks stating that the forensic audit report should be conclusive. Because what was happening, many of the auditors or many of the chartered accountants who were working on behalf of the banks, they were giving their observation but not concluding the report, whether it is a fraud or a no fraud account. The IBA, Indian Banking Association, issued these guidelines to the banks to ensure that the report should be conclusive. But still, as an auditor, what we do as a forensic accounting or forensic expert, whenever we submit our report, we don't clearly write that this is a fraud account or this is a no fraud account. We don't clearly write that. We write that these are the transactions that were observed, and these transactions seems to be falling under the definition of RBI circular of fraud, diversion, siphoning, willful defaulter, whatever the case may be. If you will see the RBI Master Circular, each and every term has been separately defined, whether it be fraud, whether it be willful defaulter, siphoning of funds, diversion of funds. It has clearly been defined in each of the RBI Master Circular. So once it has been defined in the circular, you have to religiously follow that circular. So if a particular transaction is falling under the definition of fraud, you have to clearly classify that these transactions seems to be falling under this clause of RBI Master Circular for fraud, for willful defaulter, for siphoning, or whatever the case may be. Now it is upon the banks and the court to decide whether it should be classified as a fraud or no fraud. So if you are doing any forensic audit, or any forensic such assignment, you should never clearly write this is a fraud account, because you are not a judge to pass a order. You are just an expert who can give his opinion, who can give his views that these are the transactions that we found out and these falls under this. Now, there is a very slight difference between diversion, siphoning, and fraud account. Like, if I'll give you an example, many definitions are given of fraud. If I'll just run through the PPT. If you see the definition of fraud, here section 441, they have given the definition of fraud as per 447. Then they have again defined the word fraud in IBC. They have defined the word fraud in IPC, Indian Penal Code, criminal codes. The basic intent that needs to be understood is that proving the intent is the key. You have to prove that this account is fraud or no fraud. For that, you need just to prove the intent. If the intent is malified, then you can write that this falls under this clause of the RBI Master Circular. If you find out that the intention was not malified and it is a genuine business loss, in that case, you can never classify that account as fraud. What happens as soon as you write that these transactions have been identified to fall under the definition of fraud, your report will be going to various government agencies like CBI, ED, SFIO, EOW. So these are the 4 agencies to which your report will be going. Your report can also go to the court of law for discussion, or there can be cases. The parties, the borrowers whom you are auditing might file a case against your report in the court of law. So there can be n number of cases in this regard. For that, you have to ensure that whatever report, whatever wording you are using in the report is very, very essential. If you are doing any forensic assignment for first time, second time, you should always get your report reviewed from a forensic expert who has at least done 15-20 assignments. Because in that case, he will be able to help you how to write a report, what to write in the report, and how it is to be presented. Nanda sir talked about the forensic audit standard. In one of the forensic audit standard, there is a standard of reporting guidelines, reporting outline, which talks about how the report is to be prepared. You have to clearly mention that these are the points like introduction, limitation, appendix, then main part of the report, then conclusion. Then you have to, there is a complete structure that has been provided in the forensic audit standards. From 1st July 23 onwards, these standards have been made mandatory to all the chartered accountants. Even though it has not been made mandatory to any other person, but for chartered accountant it is mandatory. Any other professional who wants to use this standard like CMA, CS, or any other person, he can use these standards and accordingly use these standards to undertake the forensic assignments. So while doing any forensic audit, it is important to proving the intent is the key. That you have to prove anything which is done with a malified intention, and it is not a case of a genuine business loss. And now the question comes, how as an expert or as a forensic expert you will prove that it is a genuine business loss or it has been done intentionally? Because see, you are not a psychologist that you can get into the mind of the borrowers and you can decide that this thing is done intentionally or this thing is done unintentionally. For that, what you need to do is, for that, you need to understand the balance sheet, the transactions which have been taken. And if you had been in the shoes of the borrower, what would you have done? As a forensic, I'll tell you one thing. I have done more than 200 forensic audits. Using the software and everything is digital, forensic, everything is fine. But basic thing that as a chartered accountant you need to learn is how to study a balance sheet. Once you are able to read the balance sheet between the lines, you will be easily able to do any forensic assignment. You need to understand whether this transaction or this presentation on the balance sheet would have been done had you been the borrower. Like I'll give you a very simple example. If any one of you would have done any forensic audit or any forensic assignment, as soon as the account becomes bad or it becomes NPA, all the debtors become non-recoverable. As soon as the account becomes bad, all the stock becomes scrap, unsellable stock, or it has been theft, or it has been destroyed, or whatever the case may be. So this is not a normal course of business that as soon as the account becomes bad, all the debtors become non-recoverable, all the stock is written off. This clearly shows the malified intention of the borrower. That till the account was doing fine, he was maintaining his drawing power, he was maintaining his limits with those debtors in stock. He was submitting his stock statement to the banks. But now, As soon as the account became bad, all these became non-recoverable. So your job is to find out that whether it is in normal course of business or not. If it is in normal course of business, then it is fine. If it is not in normal course of business, you have to clearly point out those facts. I'll give you an example of a genuine business loss. You will ask me, sir, genuine business loss, what are those examples? For an example, if you are doing any work or any trading or any goods you are selling, you had a major fire incident in your factory, or say tsunami. If you had some tsunami like it happened a few years back, if those incidents happen due to which your machinery is ruined, your stock is ruined, that is a case of a genuine business loss because that happened due to a natural calamity. You are not able to repay the banks due to a natural calamity. You have to be very sure while doing the audit what is the reason that the borrower is not able to repay that money. I'll show you the scope of the work. I'll just run through the scope of the work. We have less time today because generally my session takes around 2.5 hours. One more thing that needs to understand before going into the scope of forensic audit, forensic assignments, you need to understand what is the difference between a normal audit and a forensic assignment. See, after the introduction of CARO 2020, according to me, many of the points have been taken from forensic audit. So now if you are a auditor or you are a banker, if you run through the CARO reporting, you will come to know a lot about the borrower. They have included the diversion of funds. They have included the point in clause number 2 regarding comparability of stock statement with the books of accounts. They have included prejudicial, any transaction which is prejudicial to the interest of the company. They have included a point whether the borrower will be able to meet their liabilities in future or not. They have included a point of willful defaulter. They have included a point of Benami transactions. They have included a point of cash flows, various ratios they have included, whereby they have given a set of 11 ratios that now needs to be given in the financial statements as per Schedule 3. So now the CARO reporting has been done. CARO reporting as Schedule 3 has been done very, very comprehensively. So if you are able to read the balance sheets properly, your 50% forensic audit will be done like that. Like for an example, they have given the aging analysis of debtors and creditors. Till now, never ever, till the history of the accounting standard, never ever we used to give aging of trade payables. But now they have included the aging analysis of trade payable. The trade receivables aging has been made more comprehensive. 6 months, 6 months to 1 year, 1 year to 2 years, 2 years to 3 years, more than 3 years. Then considered good, considered doubtful, MSME, other than as MSME, disputed, undisputed. So they have created many, many sections in the trade receivable. So while doing any forensic audit, it is very important that you read the balance sheet thoroughly. Once you are able to read the balance sheet thoroughly, then only you will be able to take that assignment. You will be able to perform that assignment. The digital part comes later on. So if there is a very bulky data, then the digital part will come into focus. But it is very important for you to highlight the areas that needs to be checked. While discussing the scope of the work, I'll discuss various scope of areas of work that might help you, like trading, manufacturing, jewelry sector, hotel sector, or steel sector, cement sector, water, power sector, rice sector, sugar sector. Each and every industry that you are auditing has a separate nature to it, has separate nature of expenses that are being booked. So there, like many people ask me, sir, can you provide us a checklist of forensic audit? I said there is no checklist for any forensic audit. It is industry specific that you need to check. I'll give you an example. Like I'll take you to the scope of work. This is the general scope of work that we'll be discussing. That is generally given in the forensic audit. And this is the scope of work under the transaction audit that we do under the insolvency bankruptcy code. So this is the basic scope of work that needs to be seen. So iske andar, sir, what happens? I was giving you an example of industry specific points that needs to be checked. So if you are doing an audit for any manufacturing industry, what will happen? What is the thing that you will have to check? If you are doing an audit for any manufacturing industry, the main thing that you will be checking is the power and fuel, the wages part, PF, ESI, employee fund, employers fund. These are the major heads that you will be checking, other than the consumption I'm talking about. See, for manufacturing, Sales and cost of material consumed is one of the major head that you will anywhere will be checking. But to identify any discrepancies or anything, I'm telling you like power and fuel. Like I'll tell you an example. I did an audit for a company who was into manufacturing of batteries. This is a case of around 2014 or 15, 16. At that time, custom excise that was applicable. GST had not been introduced. So when I did an audit, they brought the balance sheet to me for audit. For statutory audit, I'm telling you. So they came to me, sir, this is our balance sheet, please sign it. So when I read their sanction letters, that what is the purpose for which the limit was sanctioned to them. The limit was sanctioned to them for manufacturing purposes. They were taking the parts, assembling them and manufacturing batteries for various e-rickshaws, cars and all. So when I reviewed their balance sheet, I observed that the excise duty that they were booking was very, very minimal. So if they are booking a turnover of say 200 crores, the excise duty they were booking was 5 lakhs, which is anywhere not possible. So when I asked them to provide me the returns and details that if you are undertaking manufacturing activity, why the excise amount is so low? The power and fuel expenses are very low. So when I compared those things with this revenue, I came to know that after 2014 onwards, their 98% of turnover was through trading activity. And they were not allowed to claim drawing power against the trading debtors and trading stock. Generally, whenever you do an audit, 2 documents needs to be very carefully read before commencing the audit. The balance sheet audit report, the complete financial statements, and the sanction letter of the banks. Because in the sanction letter, you will come to know what is allowed, what is not. Like for an example, many of the times it is written that debtors and stock pertaining to related party will not be allowed in drawing power. So if you are undertaking any audit and it has been specifically mentioned that the related party debtors will not be allowed while claiming the drawing power, then that are not to be included. And if he still including them in the drawing power and claiming drawing power, in that case, he's misrepresenting the facts before the bankers. And let me tell you, the first clause of fraud, as per the RBI Master Circular, is incorrect statement to the banks with respect to the hypothecated stock debtors claimed in the stock statement being filed to the banks. So if you are providing incorrect financial statements to the banks and claiming drawing power against such thing, stock statement to the banks, and you're claiming incorrect drawing power, in that case, it falls under the definition of fraud as per the RBI Master Circular. I'm giving you one of the example. So second example I give you for sanction letter. Many a times, like I've told you in trading sector, many a times if the limit is being given in form of term loan and CC to set up a factory, in that case, the drawing power is always allowed against the debtors which are into manufacturing and not against trading, because he has taken the loan to set up the factory and to run the factory and do manufacturing activities and not for trading. Had the purpose been for trading, the bank would not have financed him for setting up the factory. He could have simply bought and sold the goods in trading. So it is very important for you to study the sanction letters, what is allowed. Like in many cases, while claiming the drawing power, the debtors are allowed up to 90 days. The debtors are allowed up to 120 days, up to 180 days, whatever the case may be. So while calculating the drawing power itself, you have to review that. So this is a brief that I'm giving you an overview of how the forensic audit is to be started and how the work is to be undertaken. Once I run through the scope, what is the scope of forensic audit? I'll discuss various case laws as well with you. That what are the various cases that needs to be seen while doing the forensic audit. So it is very important for you to see that how the audit is to be done and what are the various scenarios. No one point can be applied for all the forensic audit assignments that you are doing. It is very difficult that you put a few 10 points checklist that these are to be checked while doing any forensic audit. That is incorrect. Some points can be common. I'll say 2-3 points can be common, but rest of the 6-7 points will always be separate for each specific audit. So I'll give you an example. If you are doing an audit for an hotel industry, then the major leakages that are found are in the revenue sector. Major leakages. How the leakages are found? Many a times I'll give you an example. So I'll come to the scope, then I'll give you the relevant examples as well. So this is generally the 10-15 point scope that is given by the banks for undertaking any assignment, any forensic audit assignment that you are undertaking. The first scope of work that they give is tracing the source and genuineness of contribution by promoter by way of equity debt infused by the promoter. So the first thing that you have to see is regarding the contribution being made by the promoter. Aapko contribution, you have to check the contribution. Now, why it is important? See, whenever any loan is given, whenever you approach the bank will tell you, sir, we are ready to give you loan. So if the project cost is 100, we will give you 80 rupees loan, and 20 rupees is to be brought by you through promoter contribution. And why it is that done? So that they check that you have the capacity to set up that factory. So if you are setting up a factory of 100 crores, you should have that experience and that financial background to run that company. That's why they ask for promoter contribution. So whenever any loan is sanctioned, see, whenever forensic audit you will be doing, it will be generally done from the initiation of the loan, generally. But the banks may decide the period accordingly. But if the loan is sanctioned, like it has become NPA within 3 years, 4 years, 5 years, so generally the banks ask for the initiation of audit since the inception of the loan. In that case, you have to check the source and genuineness of promoter contribution. Now, how will you check the source and genuineness of promoter contribution? For that, you need to verify the bank statements of the promoter from where they are bringing in the funds. आपको बैंक स्टेटमेंट में देखना पड़ेगा कि वो फंड्स कहां से लाए हैं. अब there are many scenarios whereby you will see that funds are being brought from related parties. Like I'll give you an example. I'll give you a very classic example. If you would have done audit for any of the infrastructure companies that are into road project or into EPC contract, what happens? They generally have a main company, holding company. They have SPVs in every state. So I'll take the road project example. So generally, if you have to take a road project, you have to have a registered company in Calcutta. If you have to take a project in Delhi, the company has to be registered in Delhi. So what these companies do, they generally have a main holding company, जैसे suppose ILNFS. So their main company was ITNL. And they had SPVs in each state, say Sikar, Bikaner, or Hyderabad, or whatever the case may be. So they were having SPVs in each of these states. So for an example, there is a holding company and there is an SPV. So A is the holding company, B is the SPV. NHAI gave a contract to B to build a road in, say, Mumbai. So NHAI gave a contract to B to build a road in Bombay. So once they got that contract, what is to be done? They have to infuse promoter contribution. So for infusing promoter contribution, what they do? They take money from holding company. Holding company infuses the funds into SPV, and in turn, SPV further refunds the money to the holding company as a mobilization advance. Generally, what happens, whenever a contract is given to an SPV, it is subcontracted to the main company. It is always subcontracted to the holding company. So whenever a contract is given by SPV, it is subcontracted to the holding company. For undertaking that contract, mobilization advance is given by the subsidiary company to the holding company. So you will see, so I have taken, suppose my is the holding company. I have 5 SPVs in different states. So what happens? I take mobilization advance in holding company for one company and infuse it as promoter contribution in another company. That is not a genuine promoter contribution. He has taken mobilization advance from one company to build a road in that state, not to provide it further to another company as a promoter contribution. So I'll give you an say there is a holding company A, there is a SPV in B and SPV C. A contract is got by B from Bombay NHAI to build a road. They have taken 10 crore rupees. So holding company has given 10 crore to B to set as a promoter contribution. B refunds that money to A as a mobilization advance. Now what A will do, A further takes this money to C as a promoter contribution, and again C will refund it. Same 10 crore rupees will be refunded to A as a mobilization advance. So actual mein to only 10 crores rupees came. In the system, only 10 crore had come, and not more than that. However, on the basis of 10 crores, he has rotated his entries twice, just to show it as a promoter contribution in the company. So you have to verify what is the genuineness of contribution. Now, what happens in this case? Suppose you have a company A and directors B and C. The funds are infused by B into A. Now what you have to do, once you have to take the bank statements of B and C. आपको B and C की bank statement लेनी पड़ेगी. Once you take the bank statements of B and C, on the basis, suppose if you find an unrelated party or you find the bank balances are available, then it is fine. But if you find that funds have been infused from a related party, suppose B's son has given some money, you have to take the bank statement of B's son as well. So you have to go to a level till you find an unrelated party. Till the time you are finding a related party, you have to continuously go and ask for those bank statements. When you find an unrelated party, then you can clearly state that we have checked till an unrelated party we have found. I'll give you one of the frauds that we identified. We were doing audit for a company which was into rice industry. So what happened? There is a company A, there is a creditor B, and there is a promoter C. So company A, creditor C, and promoter B, C. The company paid money to the creditor against the goods purchased. The creditor in turn transferred that money to the promoter bank account, and promoter in turn infused that money into the company as promoter contribution. मतलब कंपनी ने क्रेडिटर को पैसा दिया, क्रेडिटर ने प्रमोटर को दिया और प्रमोटर वापस कंपनी में ले आया एज अ प्रमोटर कंट्रीब्यूशन, which is incorrect. That is not a genuine promoter contribution. That is just round tripping and nothing else. So how did you identify that? Once you review the balance sheets, once you review the bank statements of the promoters, once you review the list of creditors and debtors, then only you will come to know that whether any such round tripping has happened or not. You have to review the bank statements of promoter to check what was the infusion, how much bank balance they were maintaining, and what is the scenario now. So you have to go till an extent you find an unrelated party who is not related either to the borrower or to the promoter. There was a case in which the funds were being transferred to the creditor. Creditor से आगे 3 चेन तक गया, उसके बाद promoter के पास आया, and then promoter brought back that funds into the company as a promoter contribution, which is incorrect. That is no contribution at all. It is not a genuine contribution. What happens? Bank rely on CA certificate for any promoter contribution. आपके भी काफी clients होंगे जो आपके पास आते होंगे. Sir, please provide us a promoter contribution certificate. Never sign that certificate unless and until you have the complete documents and the bank statement. Because I have seen many scenarios whereby CBI, Central Bureau of Investigation, has charge-sheeted chartered accountants who have signed such incorrect promoter contribution certificate without any working papers. You have to ensure that whatever working papers that you have before signing any certificate or anything, which is to be given to a third party, being banks or any other one, you have to be extra sure that you do not sign any incorrect certificate, let me tell you. Otherwise, you will be in trouble. Because what is happening nowadays, as soon as an account is classified as a fraud and is sent to CBI, the first people that CBI calls is the statutory auditor, second is the stock auditor, and third is the person who has given the certificate for promoter contribution. These are the 3 people that CBI calls at the first instance itself. And if you do not have the correct working papers, then it will be a big trouble for you. Because it is your responsibility to maintain those working papers for at least 8 years. So it is very important that you maintain those documents and do not sign any promoter contribution certificate unless and until you are sure that the contribution is genuine. Because please read the certificate language. Second points come regarding the revenue. So now for verification of revenue, there can be many methods. It depends on industry to industry, like I was telling you. So for an example, if you are checking the revenue of a hotel, what happens? I'll tell you what happens in a hotel industry. In hotel industry, currently I've been appointed as an RP of a hotel industry as well. So I had a meeting in the hotel itself. In hotel industry, generally they maintain 3 softwares. And what are those 3 softwares? One software that they keep is the one on the reception, which maintains the data of the guest. Second software is the one on which the entries are passed with respect to the revenue and day-to-day operations, expenses. And the third software is the one in which the balance sheets are finalized. So if any hotel industry audit that you are doing, it will always have those three softwares. Now, if you being the auditor, you only ask for the final data, which is being used to prepare the balance sheet, then you will never be able to find anything. If you are doing any forensic assignment or any investigation assignments or any audits, say stock audit or any other audit, first and foremost, you have to get the data which is prepared as per the data available on the reception. Secondly, you have to prepare the data which is prepared as per the software whereby all the income and expenses are booked. And third is the software whereby the final all the data entries are made for preparation of the financial statements. So all those three softwares have to be reviewed by you. I'll give you an example about the fraud that we identified. We were doing audit for a hotel industry. So I went to the reception. I asked them to provide me the list of the guests along with the complete details for past 1 year. See, whenever you check into the hotel, whatever details you ask, they ask you. They ask you your name, they ask you your address, they ask you your mobile number, email ID, and any government identification ID. Aadhaar card, PAN card, whatever the case, driving license, whatever the case may be. So all those data are being fed by them into the system. So what happened when I got those checklist of 1 year, I observed, suppose for example, out of 1000 entries, 200 entries were such whereby the mobile number was common. 50 were whereby the email ID was common. And 200 entries were there whereby Aadhaar number or any government identification number was not even mentioned. So what the hotel was doing, hotel was overstating its revenue and depositing cash in the bank account of the company just to inflate his revenue and to show a greeny picture to the banking industry, the banks who had lended the money to the borrower. So for a hotel industry, you need to verify all these softwares in order to verify whether any fraudulent activity is being undertaken or not. The second example, if I'll give you, suppose if you are doing an audit of, let's say, rice industry. So rice industry, if you'll see, rice कैसे बनता है sir? आप paddy लाते हो, you bring in paddy in the factory, or from that paddy you manufacture rice. So every rice industry that is selling the rice, so there can be various qualities of rice. It can be a broken rice, it can be a white rice, brown rice. There are various categories. So what you need to do, you need to check the consumption ratio. This is applicable for all the manufacturing industries, but rice being a very small component, you have to check the consumption ratio. What happens generally, what they do, just to remove the stock, they will increase the consumption ratio. Suppose for an example, from 100 kgs of paddy, they were manufacturing say 10 kgs of rice. What they will do, from 100 kgs of paddy, now they will say we have manufactured only 5 kgs of rice. So 5 kg, they will remove it from the factory without informing you. Earlier, the production ratio was 10%. Now the production ratio is 5%. You have to take the consumption ratio, the production ratio that they are consuming and producing from the factory. You have to compare it month on month, year on year, to check how much production is being done now and how much production was being done for past 3 years, 4 years, 5 years. Then only you will be able to come and arrive at a figure which will help you to identify whether any fraud is being happening or not. So if you are doing an audit for any manufacturing industry, you need to verify the revenue. For manufacturing industry, you need to compare it with the cost that is being incurred. For manufacturing industry, there can be another scenarios. For an example, if you want to identify whether the revenue booked is correct or not. So what happened in one of the industry that we were auditing, we observed that the revenue was increasing exponentially. So from 100 crores, it became 500 crores. But when we compare the power and fuel and electricity expenses, for 100 crore, suppose for an example, they were 10 lakhs. And for 500 crore, they are only 12 lakhs. So the comparison ratio is not possible at all. That the revenue has increased 5 times, but the electricity bill has only increased 20 times, 20%. From 10 lakhs, it has become 12 lakhs. But your income has increased from 100 crores to 500 crores, your revenue. It means that they are overstating their revenue. Because had they incurred that power and fuel expenses, they would have booked that in their financial statements. So generally, the power and fuel electricity expenses are booked correct. Then you need to link it with the manufacturing. You need to link it with the sales that they are booking. Once you are able to link those things, you will be able to come to know whether actually the sales are being done correctly or not. You will be able to find out the fake billing. You will be able to find out whether the genuine revenue is being booked or not. I'll give you an example of a trading industry now. We have discussed manufacturing, we have discussed hotel industry, service sector. Hotel is basic service sector. Next comes is regarding your trading industry. How will you verify the revenue of trading industry? See, you will come to know that in case of trading, there are not major expenses like power and fuel is not major, rental is not major, employee cost is not major. The major cost in your trading sector is regarding the purchases that you make, because you are doing that for a differential profit. You are purchasing an item for 100, you are selling it at 110 or 120. So you are doing the work for a differential profit. So major expenses that will be there is regarding freight and cartage. That is the major expenses other than purchases that will be there in the trading. So how do you verify the trading? So what we do is to identify whether the genuine revenue is being booked or not, we calculate the cost of goods sold. COGS ratio. See, if you are doing a sale of say 100 crores and you are booking a profit of 1 lakh rupees. So you are doing trading activity, you have done a sale of 100 crores, but you are booking a profit, COGS, gross profit of 1 lakh rupees. 99% case is that will be a fake turnover. The reason for that, you are routing 100 crores of turnover just to earn 1 lakh profit, nothing else. It is better you shut down that business. It clearly points that he's just round tripping, he's just showing fake sales and purchases just to inflate his revenue, to show a greeny picture to the banks, to avail the limits, and not paying tax to the government by showing very low profit. So if you're doing an audit for a trading concern, you need to calculate the COGS ratio. Ab kabhi bhi jaake you go today, tomorrow, you check any balance sheet of your client who's doing trading. If he is doing trading at a very, very nominal profit, 0.1%, 0.01%, I am 99% sure that it will be just book entries and nothing else. कपड़े में होती थी, क्लॉथ में, कोई सी भी इंडस्ट्री ले लो, राइस, स्टील, सब में ट्रेडिंग होती थी. इफ यू विल सी ये आपके राइस वाले, they create many firms in between. In Chandni Chowk, Chavdi Bazaar in Delhi, they have 10 firms in between, and all the 10 firms are showing the trading of rice. A is purchasing from B, B to C, C to D, D to E, E to F, F to G, G to H, H to wapis A. So these were just being done because agriculture products do not attract GST. Cloth used to not attract GST, but now it is under the purview of GST. So agriculture products, since they're not under GST, you need not register under the GST. You need not pay GST as well. You can just show the trading activities A to B by showing a nominal profit. Because if they will show huge profit, they have to pay tax on each amount. So if you are checking any revenue for trading activity, you need to check cost of goods sold ratio. COGS ratio is very, very, very important for you. Next comes, the third point comes regarding receivables. Now suppose for an example, you have verified all the revenues, all the things have been verified, but you could not find anything in that. You could not find any. I'll give you one more example of, I remembered one more example for manufacturing. To identify whether the actual manufacturing activity is being undertaken or not, the very important document is the gate pass register that you need to check. See, in today's scenario, it is very easy to make bills. You can make the bills invoices online. You can prepare the e-way bills. You can prepare all those documents. But the one document that is very, very difficult for any industry to prepare is the gate pass register. I tell it in every seminar of mine. Gate pass register is the one document which only 1% of people can fake it out, but 99% of people cannot make fake documents for that. Reason being, the amount of information that is to be fed into the system, into the register. You have to write who brought the goods at what time, in what vehicle number, and what were the goods, what was their weight, at what time he entered the factory, at what time he left the factory, his mobile number, every detail is to be mentioned. So it is very difficult for any of the factory manufacturing industry to work without a gate pass register, because the owner will not be sitting on the factory. For that, he will be relying on his guard, security guard, to review whether the goods have reached or any purchases of a manufacturing industry. The first document for me, for you to see is the gate pass register. आपको सबसे पहले गेट पास रजिस्टर देखना है वहां जाके, whether the company is maintaining it or not. If the company is not maintaining a gate pass register, that is a very, very big red flag for you. That is a very, very, very big red flag for you, because no manufacturing company can work without a gate pass register. Then you have to check all those things. Like I had verified a gate pass register for a company into sugar. I observed that one truck had made 142 trips in one day for a distance of 70 kilometers, which is not possible at all. बिल्कुल possible नहीं है. That is an impossible thing. That one truck, same truck number was entered into the transaction, showing 142 trips in a day of a distance of 70 kilometers each. According to me, that truck cannot make more than one trip in a day, because going 70 kilometers, coming back 70 kilometers, loading, unloading. So according to me, that will take 7 to 8 hours, 9 hours. So it is not possible for that truck to make more than one trip. But they had showed 142 trips. This clearly shows that they were inflating their revenue. Hence, their intention was malified. Hence, they will fall under the definition of fraud as per the RBI Master Circular. Because they have, with a malified intention, increased their revenue by showing fake entries, and they have misled the bank in showing the higher revenue to them for taking the banking limits. So you have to link each and every part with the intention thing, जो हमने शुरू में discuss करा था, that we discussed in the starting. Proving the intent is the key. So if the borrower is showing that one truck has made 142 trips in a day, this clearly shows that his intention was malified. So you have to check each and every document while doing the forensic audit. See, I tell you what is the thing. Forensic audit, forensic assignments can never be done on a sample basis. For statutory audit, you can take a plea that it was done on a sample basis. We have not verified each and every document. But for forensic audit, forensic assignment, it can never be done on a sample basis. You can have a materiality concept. See, for an example, if you are doing an audit for 1000 crore company, you can set a materiality concept, say, for example, for 5 lakhs, 10 lakhs. If you are doing an audit for, say, 10 crore company, you can set a materiality limit of 10,000, 20,000. But above that amount, whatever materiality limit that you set, above that amount, you have to check each and every transaction. आपको सारी transaction check करनी है. What is the nature of the transaction? Whether it has been done on arm's length basis or not, you have to check each and every transaction for that. That's why it is very, very important for you to verify those things in detail. I'll tell you an example what had happened with me. Same in sugar industry, I was doing an audit for one of the companies. We could not find any flaws in the revenue part. हमको revenue में कोई default नहीं मिला. That the handwriting of the sender of the good and the receiver of the good was exactly the same. जिसने सामान भेजा था और जिसने रिसीव करा था, दोनों की हैंडराइटिंग सेम थी. तो जब मैंने वो देखा कि दोनों की हैंडराइटिंग सेम है, then I called a writing expert to verify whether these writings are same or not. He unofficially told me that, sir, these writing are absolutely same on the basis of the texture of the writing and everything, that these has been sent and received by the same person. There's no second thought to that. On the basis of that, then I started my reinvestigation. I reinvestigated all the documents again. We observed these things in many of the documents, that the handwriting was exactly the same of sender and receiver of the good. I went to the borrower, I asked them the queries, they were not able to reply. On the basis of that, we mentioned that fact that the sender or receiver of the goods cannot be same. We raised an objection, we raised the suspicion as well. Since we are not a writing expert, I can never write in my report that the writing is same. Now comes the wording part. How will you mention that fact in the report? You should write that when we verified the bills, we observed that the sender and the receiver handwriting seems to be same. However, the same should be verified by a third party agency being a writing expert for the same in order to identify whether the writing is same or not. Further, we wrote that in case it appears that since the writing is same, this creates suspicion whether in actual such sales and purchase transactions were being undertaken or not. And that is why they became non-recoverable on the later date. Now you have to link, once you have identified an issue in the sales, you have to link the same with the receivables, which is your next point regarding the debtors. आपने sales verify कर लिया, you verified the sales, you observe the things कि भी these are the issues, these are the points. Now comes the second point, that is the receivables. You have to check the receivables. How will you check the receivables? Suppose I've given you examples that we have verified the sales, we have verified all the documents. Now comes the receivable part. First and foremost that you need to check is what is the status, what is the aging of those receivables. In case the debtors are outstanding for more than 6 months to 1 year, and no effective legal steps have been taken by the borrower to recover such money, this is a very, very big red flag. See, generally the working cycle for any the industry is 3 to 6 months. You leave apart the agriculture part, you leave apart the infrastructure, the EPC contractor and the infrastructure. So generally in the agriculture, the cycle is generally up to 12 months. The receivable cycle, 12 months to 15 months you can take. For an EPC contractor or the companies into infrastructure, the receivable cycle is say 2 years to 3 years because they have a moratorium on the basis of which they have to build that project and after which they will recover their money. And also in EPC contracts, since the major of the contracts are done on the behalf of the government takes a lot of time in making the payments. That's why the cycle of the infrastructure projects is a bit long. Other than that, according to me, no business cycle can be more than 3 months to 6 months, 3 to 6 months. So if you have a lot of receivables which are more than 6 months to 1 year and no legal steps have been taken, this is a very, very big red flag that he was just doing round tripping and nothing else. It is not an actual sale transaction, or he has taken the money in some other form and not brought it out through the banks. So for the receivable, see, out of the limits sanctioned by the banks in nowadays, 80 to 85% limits are in form of cash credit limits and 15-20% are in form of term loan. The major security for cash credit limit are in form of stock and debtors. They are the primary security. So it becomes your utmost responsibility to verify the stock and debtors, that why have they become non-recoverable, being the primary security of the bank. So for that, you need to identify whether the loans have become bad due to non-recovery of those debtors or stock. अब debtors को verify कैसे करेंगे सर आप? For verification of debtors, it is very important you check the status of those debtors, whether they are related or unrelated, for how long they have been outstanding, whether they are disputed or undisputed. You have to check each and every point in debtors. We observed, I was doing an due diligence for a very, very big company, which was in, I'll not name the sector. It was into very, very big industry. It was having a sale of around 550 crores. It was having a limit of around 400 crores banking limit. And it was showing a stock of 900 crores. 900 crores ka it was showing stock against a sale of 500 and a banking limit of 400. It means he was showing stock twice the amount of sales that is booking per year, which is not possible at all. Because that stock was a depreciable item or out of fashion item. So that could not have been possible keeping a 2-year stock for any of that borrower. When we asked the borrower to provide us the aging analysis, the details of the stock, he was not able to provide the stock. For that reason, we classified that account as an NPA account. We reduced his drawing power, that it is not possible in any case that he can book such stock. So while verifying the revenue, while verifying the stock, while verifying the debtors, it is very important for you to link each and everything. So for an example, if you identify the revenue is false, if the revenue is false, it means the purchases are also false. In case the purchases are false, it means the debtors are false and the stock that he's showing is false. He never had those stock with him. So while verifying the balance sheet, you have to link each and everything. In this, I'll give you one of the example of differentiation between what is diversion of funds and what is fraudulent transaction. See, for an example, if you have a debtor, so generally what happens, there is a clause in the sanction letter of the banks that the funds are to be routed through the member banks only. So for an example, you have a loan from say State Bank of India and Union Bank. You have loan from two banks. Your sanction letter clearly states that the funds are to be routed through State Bank and Union Bank only. But in case you route funds through third bank, say you route funds through Punjab Sind Bank, you route through say Canara Bank, any other bank you route it through. Then in that case, you have to check where these funds have been utilized. See, I'll tell you the differentiation between diversion of fund and fraudulent transaction. As per the definition of diversion of funds, routing of funds through any other bank account is diversion of funds. And what is fraud? Routing of funds through any other bank account and not utilizing it for business purposes, then it is classified as a fraud. So if for an example, you have a loan from Union Bank, but you have routed your funds through say Canara Bank, but the funds that have been routed through Canara Bank have been used for business purposes. In that case, you can never classify that account as a fraud account. That will fall under the definition of diversion of fund, but not fraud. However, if the funds routed through Canara Bank have been used for other than business purposes, then you can clearly state that it falls under the definition of fraud as per the RBI Master Circular. So it is very important for you to differentiate between willful defaulter, fraud, diversion of funds, siphoning of funds. You have to differentiate between all these definitions while doing any audit. So for receivables, you have to thoroughly check whether they are disputed, whether they are related parties, whether they have been realized in any other bank account, and where these funds have been used. You have to check all these things while verifying the receivables. Next points come regarding payable. Similar to receivables, similar to sales, now you have to check the payables part. For that, first you need to commence from purchases. Purchases के लिए जैसे मैंने आपको बताया, manufacturing के लिए you will have a gate pass register for manufacturing industry. For trading industry, you will check the cost of goods sold. For hotel industry, you will check the purchases or the expenses that are being booked. Once you have verified the documents for purchases and everything, then you will come to trade payable. Now, as per the CARO 2020, the audit reporting requirements, aging analysis of payables is also to be provided. This has specifically been introduced now. The reason being, what was happening? The company was making purchases but not paying to the creditor at all. So for an example, I made purchases from a company, but I'm not paying him for past 2 years, 3 years. And the creditors are increasing in year on year. So what is happening? The other company has not taken legal action against me for recovery. It is a very, very, very big red flag. Because in normal course of business, कोई भी अपने पैसे ऐसे नहीं छोड़ेगा. No one will leave their money like that for 2 years, 3 years. If I am making sale to someone, I'll ask him to pay me back in 3 months, 4 months, 5 months, 6 months. But if those amounts are outstanding for 6 years, more than 6 months, more than 1 year, for 2 years, 3 years, it is a clear-cut state that it might be a fake transaction and nothing else. It is a very, very big red flag for you. That's why I'm saying it is very important for all the chartered accountants to check, to understand the balance sheet, to read it thoroughly. What you need to do is you need to prepare a comparison of balance sheet of say past 3 years, 4 years, 5 years. Once you prepare the balance sheet, you will come to know a lot. So if the trade receivables were being shown under 6 months, but now they are being shown more than 1 year, it is a very, very big red flag. This shows that they were misrepresenting it from previous year itself. तो आपको बैलेंस शीट को पढ़ना बहुत जरूरी है. जब तक आप बैलेंस शीट नहीं पढ़ेंगे आपको नहीं पता लगेगा. Once you read the balance sheet, you will come to know a lot of points. Using the digital part comes to a very later stage. So for an example, if you get an assignment whereby the line items runs into lakhs of columns, lakhs of rows, then the digital part will come into the focus. But for that, you need to understand what areas need to be verified by you. कि आपको एरियाज कौन कौन से देखने पहले आप अगर बहुत बड़ी कंपनी होगी ना सर उसके अंदर 50,000 आइटम होंगे उसके ट्रायल बैलेंस में. If you are doing an audit for a very, very big company, they will have 50,000 line items in their trial balance, I am saying. You leave apart the general ledgers. I'm saying the trial balance. So if there are 50,000 line items, then how will you identify, how will you verify? It is not possible for you to verify each of the 50,000 line items. You have to study the balance sheet. You have to study the each and every head of the balance sheet, and then you have to decide where you have to hit upon. Debtors, creditors, stock, expenses, loans and advances. There are various share capital. There are fixed assets. There are various heads that needs to be looked upon. I'll give you a very classic example of fixed assets. The promoter was to set up a factory. He had taken a manufacturing limit. However, due to some circumstances, the factory could not be prepared. So what he did, he purchased an inventory. He purchased fixed assets of say 10 crore rupees. उसने 10 crore के fixed assets खरीदे. And from on one hand, he's showing work in progress fixed assets 10 crores, and on another hand, he's showing 10 crores as trade payables. This amount was kept outstanding for 4 years in his balance sheet. He's showing fixed assets, he's showing trade payable, but that amount was kept for 4 years in his balance sheet. After the 4th year, his account became bad, and what he did, he completely wrote off those fixed assets and he had shown it as he has booked a loss of 10 crore rupees. उसने फिक्स एसेट्स को राइट ऑफ कर दिया और 10 करोड़ का लॉस बुक कर दिया कि सर अब तो ये स्क्रैप हो गई. He had neither put them to use, he had neither paid the creditors, he had neither booked any depreciation on them. But after 4 years, when his account became bad, he had simply written off those assets of 10 crore rupees. This is a clear-cut case of fraud whereby no actual purchases were made by him. No actual amount was to be paid to the creditors. No actual depreciation was to be booked since it was never put to use. And the scrap entry was just a eyewash and nothing else. Now, how will you come to know? You will come to know when you compare the balance sheet year on year. You will come to know that an amount of 10 crores is coming regularly year on year in his trade payables. And no legal steps have been taken by the creditor. No efforts have been made by the borrower to pay that money. This is a clear-cut case of fraud or incorrect misstatement in his financial statement, whereby he is showing incorrect amounts. So for verification of trade payables, trade receivables, you need to link each and every item. Next point comes regarding reviewing of accounting policies, practices and accounting standard. While doing any forensic audit assignment, you need to be sure, you need to understand, you need to know about the forensic audit standards, you need to know about the investigation standards, you need to know about all the standards that are applicable to the company at the moment. If you don't know about this, like Ind AS talks about time value of money. So if you are doing any audit, you're doing any work, you need to understand about the accounting. I'll give you an example. We were doing an audit for a company which was not showing any liability in its books of accounts. They were showing an amount as a contingent liability as per accounting standard 29. But when we reviewed those documents, when we but intentionally by applying AS 29, which talks about contingent liability and crystallization of liabilities in the balance sheet, he was showing it as a contingent liability so that he did not reduce it from his balance sheet and drawing power. So he was not following AS 29. AS 9, revenue recognition. In an EPC contract, the revenue is booked on percentage of completion method. POCM. He was not booking his revenue on POCM, he was booking his revenue on cash basis, which is not allowed as per the accounting standard. Valuation of inventory, AS2. I'll give you a classic example of that. We were doing an audit for a company. which was showing the inventory in his balance sheet and it was showing inventory in his stock statement. तो वो क्या कर रहा था सर, उसने अपनी बैलेंस शीट में जो स्टॉक दिखाया वो दिखाया फीफो बेसिस पे. So if say 100 kgs of mobile phones is showing, he is showing it on FIFO basis in balance sheet, but he is showing on weighted average while submitting the stock statement. तो स्टॉक स्टेटमेंट में तो वेटेड एवरेज दिखा रहा था और बैलेंस शीट में वो दिखा रहा था FIFO basis पे. By that, even though the quantity was same in his balance sheet and stock statement, the valuation were varied. In balance sheet, he was showing a valuation of 50 crores. In stock statement, he was showing a valuation of 75 crores because of the change in method of valuation. The quantity was same. Say quantity was 1000 phones. It was same in both. But by applying different methodology, he defrauded the banks. You will never come to know unless and until you know accounting standard 2. आपको जब तक अकाउंटिंग स्टैंडर्ड 2 इन्वेंटरी का नहीं पता होगा, आप नहीं फाइंड आउट कर सकते. So while doing any audit, related party transactions, AS18, this is a very, very important transaction. I'll tell you something about this. While doing while verifying any of the balance sheets or doing any audit, you have to go beyond the definition of accounting standard 18. अब वो कैसे करेंगे सर? मैं आपको एग्जांपल देता हूं सर. हमने एक कंपनी को ऑडिट करा सर. उसके अंदर क्या हुआ, जब हमने उस कंपनी के पार्टीज के नाम ढूंढे, वी फाउंड आउट दैट आउट ऑफ around 1000 crores were invested in around 750 companies by that person. 1000 crore रुपए उसने 750 कंपनियों में इन्वेस्ट करा होता है शेयर कैपिटल. When we verified those 750 companies on MCA website, we observed out of those 750 companies, even though the directors were not same, 300 companies had same address of a Calcutta in Calcutta. 750 में से 300 कंपनियों का सेम एड्रेस था कैलकाटा का. जब हमने उसको कैलकाटा, when we got to visit the Calcutta office, we observed that it was a 10 by 10 shop and it was closed and there was nothing in that. In that case, since even though they were not related as per accounting standard 18, we mentioned in the report that out of the 750 companies, 300 companies have same addresses and these seems to be indirectly related to each other. Indirect relation. Hence, by lifting the corporate wheel, since all these companies have same addresses, these are indirectly related to each other and further investigations to be done by the government agencies or whoever it case may be. So even though the companies were not related as per the accounting standard 18, you had to lift the corporate wheel and you have to verify like common address, common email ID, or say common contact number. Even if you find any of those things, you have to mention that fact as an indirect relation. काफी बारी क्या होता है, it happens that employee of a company is made director in another company. That is also an indirect relation. Suppose I am an employee in company A. I resign from company A and open company B. And within a period of 2 days, I start doing trading with A and B. This clearly shows that he has intentionally left the job, became a director in another company and started trading. So this is a case of an indirect relation. Common address I have told you. So if you find, it's like if you are doing any of the audits, you're doing a stock audit or you're doing any audit, if you find that there is a common address for debtors and creditors, you should clearly point out that fact in your report. It is a very, very big red flag that two unrelated companies have same address. They have same contact number. They have same email ID. It is a very, very rare thing. Unless and until the chartered accountant or the company secretary has put in his email ID. You should never put your email ID. Let me tell you that. आप कभी भी अपना email ID या अपना contact number किसी भी client के MCA हो, anything हो, bank हो, कहीं पे भी हो, do not give your email ID or contact number because it will be a trouble for you in future. Because what happens as soon as the account is classified as a fraud account or it goes to CBI, the borrower states that these email ID and mobile number belongs to my CA, hence he was the one who was handling everything. So never give your account number, email ID or contact number whatsoever case for any of the companies that you're auditing. So while reviewing any forensic audit or any assignment, you have to check the policies, you have to check the practices, you have to check the accounting standard. Next point comes regarding money trail and end use of the funds. Now, as per CARO 2020, in clause number 10, I guess, you have to mention whether the funds have been utilized for the purpose for which they were sanctioned. Basically, you have to comment on end utilization of funds. These comments have been picked up from forensic RBI Master Circular of Fraud Examination itself. ये RBI circular से ही point उठाया है कारो में भी. As a forensic expert, you have to verify the money trail and end use of funds, where the funds have been utilized by the borrower. You have to prepare a complete chart of showing opening balance, inflows, outflows, and closing balance. You have to clearly show that fact in your report, that the funds were utilized and the funds, and what is the end utilization of those funds, where the funds have been utilized. In that case, you will come to know that how the limits have been utilized. Say, for an example, there is a clause that short-term funds cannot be used for long-term purposes. So if you have taken a CC limit, that funds cannot be used to purchase the fixed assets. In case the short-term funds have been used for long-term purposes, that falls under the definition of diversion of funds. वो diversion की definition में fall कर जाएगा sir. So you have to ensure that short-term funds are never used for long-term purposes. Similarly, and that, how can you identify that fact? You can identify that fact only if you check, only if you review the bank statements and the bank book that is provided to you by the borrower and the banks. Once you are able to review those facts, once you are able to review those amounts, you will come to know how the funds have been utilized. Whether the short-term funds have been utilized for long-term purposes, long-term funds have been utilized for short-term purposes, you will come to know. Has any fixed assets been created from a CC limit? In that case, you have to bring out that fact in front of the bankers. Reason being, then the banks will be able to attach those properties on behalf of the borrower. That our CC limit has been misutilized to create an asset. Hence, this asset should also be attached with us. So it is very important for you to prepare the money trail and end utilization of funds. Next points come regarding examining routing of turnover in the account. You have to verify whether the funds have been routed through the member banks only. In case the funds have been routed through outside consortium, outside member banks, outside the banks who have given the loan, then you have to check what is the utilization of fund in such bank accounts. In case the funds have been utilized for the business purposes only, then it will fall under the definition of diversion but not fraud. But in case the funds have not been utilized for business purposes, then it will fall under the definition of fraud as per the RBI Master Circular. So you have to check first and foremost whether there was a condition in the sanction letter. 99% there are conditions in all the sanction letters that funds are to be routed only through their bank account and no one else. 99% there will be a condition. And after verifying that condition, you have to ensure that funds are being utilized for the business purposes only and not for any other purpose. Next points come regarding physical verification of debtors. See, I've talked about the verification of debtors. In some cases, in some scenarios, the banks give us a scope to physically verify the debtors. In that case, what you have to do, you have to visit the premises. If the premises is open, you have to request the debtors to provide you the confirmation and what dealings he had the borrower. If he does not cooperate, you simply return and mention that fact in your report that the debtor did not cooperate. Since you do not have the power of a government agencies, you cannot mention that fact. You cannot fight him. You cannot force him to provide you confirmation. You can just request him to provide the confirmation. You can click photographs from outside the premises, and then you can attach that in your report. But you can never force a debtor to provide you the confirmation because you do not have those powers. Next points come regarding arm's length transaction. You have to check whether the transaction with the related and unrelated party are done at arm's length or not. वो कहां से पता लगेगा सर? आपको चेक कैसे करना है सर? Suppose for an example, I have two phones. These are the two phones I have. So one of my phone I'm selling at a same phone. They are similar phone. One of the phone I'm selling at a price of 50,000 to an unrelated party, and to a related party I'm selling it for 30,000. How will you come to know? You will come to know this fact when you verify the inventory, the stock register. Once you verify the stock register, you will come to know what amounts they are charging. After that, you will check whether these transactions are being done at arm's length or not. After you verify the stock register, after you verify the sales and purchase register, you can easily come to know whether it is done at arm's length or not. Secondly, you can also refer to the transfer pricing report, TP reports, in case the amount is more than 20 crores in case of domestic transaction, or any amount for an international transaction. For that, transfer pricing report needs to be filed with the income tax authorities. You can verify that. But आपको generally books of accounts से देख के आपको पता लग जाएगा whether the transactions are being done at arm's length or not. Second, next point comes regarding unsecured loan. This is similar to your promoter contribution. See, promoter contribution can be in two forms, either in form of share capital or in form of loans. So whatever the case may be, you have to verify whether the unsecured loans have been introduced from a proper source and from a genuine source, whether the contribution in form of unsecured loan is genuine or not. आपको वो verify करना पड़ेगा सर. Only you will be able to comment on this part. This is similar to the first point that we had discussed. Then examining the transactions with promoter partners or bogus family transaction, this is basically the related party transactions. You have to verify that whether the transactions with related parties are genuine or not. Again, your accounting standard 18 will come. You have to check whether they are indirectly related. You have to check whether the transactions are done at arm's length or not. All those checkings needs to be done by you with respect to the related party transactions. Next points come regarding your transaction audit. That is the transaction audit that is to be done as per the IBC code, Insolvency Bankruptcy Code. This is also very important for you while you are doing any forensic assignment, because the forensic assignment can either be done by the banks or by a resolution professional. So it can be done by any of the person. So basically in IBC, there are 4 sections, 43, 45, 50 and 66 that you need to verify. 43 is regarding preferential transaction, 45 is regarding undervalued transaction, 50 is regarding extortionate transaction, and 66 is regarding fraudulent transaction. So whatever scope we have discussed in the forensic audit, forensic assignment thing, that similar scope will fall under your section 66. So basically forensic audit is a part of a transaction audit, because आपका 66 में सब fall हो जाता है. 66 covers everything. It does not have any scope. It is basically you have to verify the complete books of accounts and you have to identify whether any fraudulent transactions were observed by you or not. Other than that, these are the 3 additional sections that you need to follow while you are doing any transaction audit. They are preferential, undervalued, and extortionate. Now, what do you mean by preferential transactions? Preferential transactions are those whereby preference has been given to unsecured creditors over a secured creditors. So for an example, you were having limits from, say, State Bank of India. So you were having limits of, say, around 10 crore rupees. You also had an unsecured loan of 2 crores from your related party. Just before the company got admitted into NCLT, you repaid those 2 crore rupees of unsecured loan from related party, but did not repay the banks, even though the banks had the first charge on such amount. This is a clear-cut case of a preferential transaction. See, their time period has been defined in preferential transaction. 2 years prior to commencement of insolvency for unrelated party and 1 year prior to commencement of insolvency for related party. So you have to check. Oh, I ulta bol diya maine. 2 years prior to insolvency for related parties and 1 year prior to insolvency for unrelated party. तो आपको ये ट्रांजेक्शन चेक करनी है विद रिस्पेक्ट टू प्रेफरेंशियल ट्रांजेक्शन एंड यू कैन नॉट गो बियॉन्ड दैट पीरियड बिकॉज दिस पीरियड हैज बीन डिफाइंड अंडर द एक्ट. If you find any transaction prior to this period, then you can classify it under section 66 if you find it relevant for that 66 part. But for preferential, undervalued, extortionate, the period has clearly been defined in the IBC code. 2 years prior to insolvency for related and 1 year prior to insolvency for unrelated party. Next is the undervalued transaction. Now, what do you mean by undervalued transaction? Suppose I have this phone. The phone is, say, for 50,000 rupees. But I have sold it to someone just prior to insolvency date at an amount of, say, 5,000 rupees. मैंने 50,000 का फोन 5,000 में बेच दिया. That will fall under the definition of an undervalued transaction. This means the goods have been sold at a value way below its market value or realizable value with an intention to defraud the creditors. कि अगर ये मैं 50,000 का चीज मैं 5,000 में बेच रहा हूं, if I am selling a goods of 50,000 at 5,000, it means I have created a loss of 45,000 with a malified intention so that the money does not go to the bankers. This is a case of an undervalued transaction. Next comes the extortionate transaction, section 50. What does it talk about? It talks about whereby we have taken a loan or any limit which is prejudicial to the interest of the company. Now, what do you mean by that? Say, for an example, I already have a loan of 10 crores from State Bank of India. I took a loan from, say, ABC Finance Limited, an NBFC, of 10 crores, but at a rate of interest of 30% per annum. My State Bank loan is going at 10%, but I took a loan of 10 crores from an NBFC, private NBFC, at 30% per annum. So that is an extortionate transaction because I am taking a loan at such a huge rate of interest, which is prejudicial to the interest of the company. इसका एक और एग्जांपल होता है. Suppose मेरा स्टेट बैंक से लोन चल रहा है 10 करोड़ का. It is to be repaid within 10 years. I took a loan from NBFC for 10 crores, whereby repayment is to be made in 1 year. State Bank का तो loan I have to repay in 10 years, but that NBFC loan I have to repay in 1 year. So the terms and condition of such debt are prejudicial, are exorbitant in nature, whereby the rate of interest is high, 30%. The terms of repayment are such that I have to make a payment within 1 year. Or security interest. For example, I have taken a loan from State Bank of India for 10 crores. I have given a security of 5 crores. Whereby I have taken a loan from NBFC for 10 crores. I have given a security of 100 crore rupees. So the security interest has been created such that it is prejudicial to the secured financial creditor already existing in the financial statement. Then it will fall under the definition of extortionate. And the last parts come regarding the fraudulent transaction, whereby you have to analyze the complete balance sheet, you have to analyze the complete financial statements in order to identify whether any fraudulent transactions have been undertaken or not. So this is regarding the forensic audit and the transaction audit. This is the basic summary. I'll share the PPT with the ICI team so that they can share it with everyone. Now, Akshit ji, if there are any queries, we can take the queries, or if you want me, I can run through the forensic standards for the benefit of the members. Just to give an overview of the forensic audit standards. Akshit ji, are you there? Akshit ji, I guess, is not there. I'll just run through the forensic audit standards if the time permits. Yeah. So I'll just run through the basic standards that are there. So basically, the forensic standards, the forensic accounting and investigation standards have been bifurcated into 6 parts. Key concepts, engagement management, executing assignment, specialized area, reporting, and quality. So these are the basic 6 standards, 6 criteria that has been made. So in key concepts, what is to be seen? The nature of engagement for which you are doing the audit, the fraud risk, the laws and regulation that are to be applied, and the applying hypothesis, that what assumptions you have to take. Basically, the 100 series is about how to prepare for an assignment. What was your engagement? What was the risk? What are the laws and regulation? What are the hypotheses? The second part is now at the commencement of the assignment. Engagement management, that you have to send the acceptance. In case you identify you have to use the work of an expert, you can use the work of an expert. Then whatever observations you have, how to engage with the agencies, the government agencies, communicate with the stakeholders, basically the borrower, the banks who has appointed you. You have to discuss the same with the stakeholders. Next is executing the assignment, the 300 series, whereby you have to check how to execute the assignment. You have to plan the assignment, you have to collect the evidences, you have to collect the documentation, the working procedures that are to be followed. You have to conduct the interviews of any whistleblower or any of the employees if required, review and supervision, then testifying before the competent authority. So if your report is there, if it has gone to any of the government agencies, you have to testify as a witness before them. So जैसे अगर मेरी if any of my report goes to Central Bureau of Investigation and I have written that it falls under the definition of fraud as per the RBI Master Circular, then they will call me to discuss that report and to be a witness to say that on the basis of my report, they are classifying the account as fraud account. So they will become a witness. We will have to become a witness. For that, we will testify before the government agencies and will become a witness. Next come the specialized areas. What are the specialized areas? Applying data analysis, evidence gathering, loans and borrowing the related and connected parties. तो आपको data analysis लगानी है. So if you require any of the softwares or you require any of the expertise for data analysis, you have to use those things like Excel. You have to be good at Excel. You have to be good at software, the SAP, ERP. You have to be good at extracting the data. So you have to review all those things. आपको फिर evidence gather करना है. See, if you are doing any assignment relating to forensic assignment, your working papers have to be properly be maintained. I had done an audit in 2015 and I got a call from CBI last month. कि सर आपने 2015 में you have done an audit in 2015, so you are requested to bring your working documents and present before us. So even though the time limit has been defined of 8 years or everything, but in case of these specialized assignments, I would recommend you should maintain the data as long as you can. Minimum is 8 years, but it is expected that you maintain this data beyond that as well, so that in case any of the government agencies or any of the court calls you, you have to ensure that you appear before them. Loans and borrowings, you have to identify whether the loan has been used for the purpose for which it was sanctioned, for what purpose the loan was sanctioned, and whether it has been used or not. All those things are to be verified. Then comes the reporting results. That, like I was telling you about the outcome, I'll go through the reporting results once. मैं आपको reporting results पे ले जाता हूँ सीधा. See, these are the basic elements that you need to have for your report. What are those elements? Title, address, scope. What is the scope and objective of your assignment? Approach and work procedures to be undertaken. Executive summary of the results. References used. Any material departure, any limitations, your finding, assumptions, conclusions. So this is a basic draft of report that you need to follow. It is not a specified format. It is just an indicative list that you should have these paras in your report. But you can add any further documents that you require. You can add any other things that you require in this reporting results for better presentation of report before any of the authority or before the appointing authority. So this is just an interactive list that the reporting results can be presented. Then last is the quality control. You have to ensure that the quality of work that is being presented by you is of the highest of the qualities. The staff that you use should have knowledge of the basic understanding of the balance sheet. Because generally what happens, we send our articles, we send our paid, which do not have an experience in bank audits. Being a specialized assignment, you should ensure that whatever staff you are using for the purpose of forensic audit should have a knowledge of accounting standards. They should have knowledge of RBI circulars. They should have knowledge of Excel. They should have knowledge of RBI's, your data software, data analysis. They should have that basic knowledge so as to undertake that assignment. It can be monitored by a senior person, but the person who is doing the work at the ground level, they should have this basic understanding, because on the basis of their queries only or their observations, further replies or further things can be raised by the senior. So whatever staff that you are using in while doing any forensic audit assignment, you should ensure that they are qualified and they are able to undertake the assignment in the best possible way that is there. So these are the basic accounting, the forensic standard that I needed to discuss with you. So in case if there is any query, I guess if you are allowed to send it in the chat box, you can send any of the queries in the chat box. Or I don't know whether you have the authority to unmute yourself or not. I'll just check with the ICI team. Just hold on. Hello, Akshiji.
Yes, sir. Yes, sir.
Yeah, so my presentation is complete. So if they have any queries, then we can take the queries.
First of all, thank you so much, sir, for this amazing presentation. I hope all the participants and members must have been enlightened by your words of knowledge. I have, sir, a couple of questions if you would like to answer.
Yeah.
One question is how to verify the transactions from the books of the borrowers if the books themselves are not available, how to check or verify the transactions?
So, for doing any audit, I'll say 80% of data is to be taken from the banks and 20% is only dependent on the books of accounts. Reason being, once you have the balance sheet that are in the public domain, you have the sanction letters, you have the bank statement. See, we do require the cooperation of the borrower, but there are around 60% of cases that I've done whereby the borrower do not cooperate, knowing that after they provide the books of accounts, it will be difficult for them to give any replies to the queries that we raise. What we do in that case, we review the bank statements in detail. We take all the narrations from the bank with respect to the inflow and outflow of funds. On the basis of that, we compare it with the stock statement, we compare it with the balance sheet, and we clearly mention that the borrower is a non-cooperative borrower. So in case of a non-cooperative borrower, he has to clearly be classified as a willful defaulter by the banks. That is the first step that they take. They classify the account as a red flag account, and then on the basis of our report, they take action regarding fraud or not. So even if you don't have the books of accounts, I guess स्टॉक स्टेटमेंट, बैंक अकाउंट, बैंक नरेशंस, यू हैव टू, आपको उसमें काम थोड़ा ज्यादा करना पड़ेगा. आपको बैंक से नरेशंस लेनी पड़ेंगी, वो सारी चीजें करनी पड़ेंगी, बट द वर्क कैन बी डन.
Thank you, sir. One more question is, for whom the forensic audit is mandatory under statute?
Sir, basically it is mandatory. There is no such as a mandatory thing, but it is a guideline to the banks that in case for above 50 crores, they have to classify whether the account is fraud or not. So above 50 crore, whoever account has a limit of above 50 crore, they have to get the audit done mandatorily by the banks. Below 50 crore, it is call of the banks whether internally they want to decide or they want an expert for that. But generally, banks also appoint CAs for below 50 crores as well.
All right. Thank you so much, sir. These were the questions asked. And to all the participants, whoever requires the presentations of the speaker, they can directly contact the board, requesting them to email them the presentations of the speakers. Thank you once again so much to CA Rahul Jindal, sir, for taking time from his busy schedule and enlightening the participants on the forensic accounting topic.
Thank you, sir. Thank you, Akshay. Thank you.
So that will be all. Thank you. Have a good night.